product lotus and estimated changes in the price and the cost per year. So we are given the annual, that is the average annual demand in units, 2023, 50,000. And then you're given the growth rate. And then we have the selling price per unit, 500, the growth rate, 5%, direct material cost, 90 shillings per unit, growth rate, 10%. Then you have the direct labor cost, which is basically 200. The growth rate is basically what? 10%. Variable production of hides per unit, 40, growth rate, 10%. Fixed production of hides, 100,000, growth rate, 5%. Administration of hides, 80,000. And basically that amount, because you can see it's not be given per unit, that automatically is a fixed cost, a growth rate, 5%. Variable selling and a distribution cost per unit, 30, which basically give us what? And actually the growth rate is 10%. Fixed selling and distribution, 60,000, growth rate is 5%. So what we are required to do here is we prepare the forecasted statement of profit or loss given the current projections. Roman 2, we are required to determine the break-even levels in units and also revenue for the next 5 years. And number C, we are producing a graph, present the summary of revenue, profit, break-even, revenue for each of the next 5 years. So these are very, very simple question. It's a very good question here. We are going to start with part A. Part A of the question, whereby we are required to do what? We are required to do what? We are required to prepare the forecasted profit statement given those particular projections. So this will be our solution here. Will be our solution. And we are going to start with part A. Part A of the question, what are we required to do here? We're required to prepare the forecasted statement of profit or loss. So basically, what you're told, there is some information which you're given here that Delaware Limited would like to evaluate its performance for the next 5 years. So basically, we are going to prepare this projected statement of profit or loss for the next 5 years from 2023, and basically that is the next 5 years from 2023. So we will start with the year 2023 here, 2024, and basically we're going to have up to which year? I think that one should be up to 2028. That's the position. Yes, because we have 1, 2, 3, 4, 5. Yes, it should be up to 2027. 5 years. 5 years. That's basically what we have. Now, how do we prepare this forecasted statement of profit or loss? So basically, to prepare the forecasted statement of profit or loss, we need first of all to compute the sales of the company. We will then proceed with less the production cost. We get basically what? We get the gross profit, and then we less the other expenses. The other what? Expenses or the other costs which are not necessarily production cost. Now, for us to be able to do that, we need to have all these variables, because you can see we are only given the variables for the first year. So we need to compute the variables, those variables for the next 5 years. So let's me copy this. I have that on the other side here. I'll copy of those variables, and equally I'll copy for the first year here. That is the variables which are given for 2023. Yes. And then what we are given here is the growth rate. And basically we're told that the following details relate to the main product lotus and the estimated changes in price and cost per annum. So whatever you're given here, these are the changes per annum. These are the growth rate per annum. So what we need to do basically, we need to compute the values for the next 4 years here. So the growth rate for these for the annual demand, this one we are told will be 10%. So this in 2024, the average annual demand in 2024, this one will be equal to 110% of this one. In other terms, this one will be equal to 1.1, which is the same with 110% times what? Times this. That's her. So we do the same for this other item here. that is the selling price per unit. This one will grow with 5%. So this one will be equal to 105% of the selling price of 2023. So this one is basically the same with what? Is the same with 1.0 5. 1.0 what? 1.0 5. 1.0 what? 1.0 5. So basically, let's do that. We take 1.0 5 times this one. Then direct material, this one will increase with what? 10%. So therefore, this one will be 1.1 times this value here. And remember what we are doing here, we are basically developing a formula. So this formula which we will develop here, we are going to apply that for the next 3 years. That's yes. Then the direct material here, this one will also grow with 10%. So basically, instead of doing that manually, we can be able to apply the formula we have up here. This formula will apply for direct labor because it will also grow with 5% and also the variable production of hides. That's yes. So this is 110% of this, is 110% of this. That's yes. What about this one? This one will grow with 5%. So this one will be equal to 1.05 times this one. Yes. And basically this administration of it, also this one will grow with 5%. You can also apply that formula down here for this other item. That one is 105% of this. So this one will grow with 10%. So this one will be equal to 1.1 times what I have here. I enter. And finally, this one will grow with 5%. So this one will be equal to 1.05 times what I have here. I enter. Sasa, yes. So then what I'll do, this particular formula which I've developed for 2024, it will basically apply for the next 3 years. I'll just apply that formula there, and I'll be able to have the values for the next 3 years like that. Sasa, yes. So basically, we say that you can be able to confirm, for example, how we are computing each of the values here. So maybe what I need to do, let me do away with this decimal. I think we have decimals. Do we work with the decimals? Yes, let's work with our figures to 2 decimal places here. To 2 decimal places. 2 decimal places like that. 2 decimal places like that. Let me expand these columns here. Yes. So basically we said here, you can be able to confirm how all these values have been computed. For example, if you want to know how this figure has been computed, you just highlight that cell and then you come up here. So a formula is not appearing up there. Why is the formula not appearing? Our formula, remember our formula should appear up somewhere up here. I don't know why our formula is not appearing there. Okay. But the formula basically should appear up here. I don't know why it is not appearing. Yes, but basically our formula should appear up there. Yes. So, but basically if you check here, for example, this one is like 110% of this. 110% of that. I don't know why our formula is not appearing up there. Let me first of all close this and then I reopen afresh. I close this and then I reopen. Yes, I think now we should be able to have our formulas up here. So we said if, for example, yes, our formula is now appearing up there. If you want to know how any of the figure here has been computed, you just highlight that cell and you'll be able to see the formula up there. For example, this value here, you can see it's 110% of that, which is basically very much correct. So therefore, basically all these particular variables here, or we have been able to come up with these particular variables using the figures for the base period 2023 and the growth rate. Now, having these 10, what do we need to do? We need to compute the profit or loss. How do we compute this profit or loss? We can come up with a formula here. To compute the profit or basically loss, we first of all compute the sales. We first of all compute the sales of the company. Then we minus the cost of production. The cost of production. So this is basically the production cost. This is the production cost. The production cost. We will get the gross profit, and then from there we move, and basically we less the other expenses. The other expenses, these are the non-production costs. The non-production costs which are incurred by what? By the company, or basically the other costs which are incurred by this company, which are not necessarily production what? Production cost. Production what? Costs. Yes. So that's basically how we compute the profit or loss. So therefore, what we need to do first of all is we compute the sales. How do we compute the sales? This one is computed by taking the quantity produced and sold times the selling price per unit. The selling price per what? Per unit. So that's basically how we are going to compute this. So for 2023, I will take this one, the annual demand. Annual demand, remember, the number of units to be produced and sold. This one, I'll multiply that with the selling price per unit. The selling price per unit is this one, like that. Then I'll basically do the same here, just like what you have done up here. I will basically develop the formulas for computing these variables for the year 2023, and then I'll apply that formula for the next 4 years. So that will make our work very easy here. So to these sales, we need to proceed and we less. We need to proceed and we less the production cost. The production cost. The production cost. Now, this production cost will comprise of what? This one will comprise of direct material cost, direct labor cost, variable production of heights, and then the fixed production of heights. These are production costs. But if you check on administration, these are not production costs. The variable selling and the distribution are not production costs, and the fixed selling and distribution still not production what? Cost. Let me first of all, I less this particular production cost, but I need to do some editing as far as this is concerned. This one should not be per unit. Direct labor will not be per unit. Will not be per unit. The variable production of heights will not be per unit. Yes, so that's basically what we need to have there. So I will start by computing direct material cost. Direct material cost, this one is equal to direct material cost per unit, this one, times the unit produced and sold. And I hope you can be able to record, we said at a CVP, we assume the units produced are, or RR, the units produced are equal to the units sold. We don't have crossing stock here. So I will multiply that with the units produced, this one. For the labor cost, I will do the same. Labor cost per unit, this one, times the number of units produced and sold, 50,000. Then variable production of heights, I will take the variable production cost per unit, this one, times the number of units produced and sold, this one. Then for fixed production of heights, this one does not depend with the number of units produced. This one, we take that amount there. Yes. Sasa, yes. So then from there, what we need to do is basically we get the gross profit. We will get the gross profit. The gross profit. How do we get the gross profit? The gross profit will be equal to the sales, this one, minus the production cost, minus this, minus this, minus this one, minus this one. So the sales minus the production cost. We get what? We get the gross profit there. So once we get that gross profit, we need to proceed and we less the other cost of this company. We need to less the other cost, and basically I've said that these other costs are the non-production costs. Other costs. Other what? Other costs. So the other costs, basically, these are the other costs of this company, which are not necessarily a production cost. So I think I will pick these 3 costs here. I copy them, I bring them down here. Yes, I will start with administration of height. And administration of height, I say that this one take into account we are given a figure. This is a fixed cost. This one will not have to be based on the number of units produced and sold. Variable, setting a distribution, this one will not be per unit, but basically this one has to be computed. This one will be equal to the variable setting a distribution cost per unit, this one, times the number of units produced and sold, these ones, 50. Then the fixed setting a distribution is what we have here. That one is equally not per unit. Yes. So I think having that now, we can basically proceed and we compute what? We compute the profit, the profit for the year. The profit for the year. The profit for the year, of which now the profit for the year, this one will be the gross profit minus the gross profit minus the other costs. Minus the other what? Minus the other costs. So this one will be equal to, this one will be equal to the gross profit, this one, minus these three costs, minus this, minus this, minus that one. We get what? We get the gross what? We get the gross profit. And I think having this now, we are done. We are done because we have developed a formula here. So what we just need to do is we apply that formula for the next what? 4 years here. We just apply that formula for the next what? 4 years like that. Just like that. Yes. So maybe just need to expand our columns here. Yes. So basically that's what you have, and maybe you can underline what need to be underlined here. We can underline this. We can equally underline those two values here, like that. Yes. So basically in our case, we have the profit for what? The profit for the year there. And basically this is it, that what is required as far as part A of that particular question is what is concerned. That is what was required there. You can see that one is quite simple. Quite simple. Quite what? Simple. Variable setting and distribution. Variable setting and distribution. Variable setting and distribution. Variable setting and distribution. This one rules. We have said this one has to be. I hope you can see up here. This one is per unit. So that's why we have taken this particular amount. I hope you can see how we have computed that. We have taken this times the number of units produced and sold, times the number of units produced and sold, this one. That's why we got, I think, a figure of 1.5. This times that. That the variable setting a distribution cost per unit times the number of units produced and sold. Yes. So in our case, basically we are done with that. And we said the advantage with Excel is to make our work easier. You can see we just need to come up with a formula for computing those figures for the first year. Once we are done with that, we just need to apply that formula for the next 4 years. So which basically becomes quite what? Simple. So let's move to the other part of the question. We copy this. We copy this, and basically we have it down here. Yes, so what you're required to do here is we compute the break-even levels in units, the break-even in revenue for each of the next 5 years. In other terms, what you're required to compute here are two things: the break-even point in units, the break-even point in what? In shillings. I hope you can be able to recall what we said yesterday, how we compute the two. How do we compute the break-even point in units? This is basically how we compute the same. We take the fixed cost divided that with the contribution margin. Yes. For the break-even point in revenue, or basically in shillings, we compute that by taking the fixed cost, divided that with something called, okay, yes, there we just use the same formula up here, but whatever we get, we can multiply that with the selling price per unit. Sasa, yes. So we need to have some items here. Number one, we need to have the fixed cost of this company. We need to have the fixed cost. The fixed what? The fixed cost of this company. Now, the fixed cost, basically this comprises of the fixed production cost and the other fixed cost, or the total cost. We don't, here we consider all the fixed costs, not necessarily the production fixed cost, but all the fixed costs, all the fixed what cost. Now, this company has got a number of fixed costs from what we have up here. So number one, we have this fixed production of height. That is basically the fixed cost. And then do we have any other fixed cost? Yes. We also have this, the fixed administration of height. And then we also have this fixed selling and distribution, this one. Yes, we consider all the fixed costs, all the fixed what? Cost. That will basically give us 240,000. Then, having said, we also need to proceed and we compute something called the contribution margin. The contribution margin. The contribution margin per unit. The contribution margin per unit. How do we compute the contribution margin per unit? The contribution margin per unit, this one is equal to selling price per unit, represented by small p, minus the variable cost per unit. The variable cost per unit. And equally here, when considering the variable cost, we consider all the variable cost of the company. We consider all the variable cost of what? All the variable cost of the company, all the variable cost of the company, or the variable cost of the company, or the variable cost of the company. As is asking about administration of it. Yes, basically I've said, if you check on the data which you have here, you can be able to tell which costs are fixed. Any cost which is not given per unit is fixed. This one is fixed because you can see it's not per unit. This one is also fixed, it's not given per unit. This one is also fixed. That's why I've said we have 3 fixed costs. This one, and this one. These are fixed costs. The 3 are fixed costs. They are fixed costs because they are not given per unit. If they are per unit, then they should be variable. Now, let's move and we compute the contribution margin. And basically, contribution margin, I've said we take the selling price per unit. So the selling price per unit, we have it here, this one, 500, minus all the variable costs. The variable cost, we have direct material. I'll take 500 minus direct material, which is a variable cost, minus direct labor, minus variable production of height, minus the variable selling and distribution, that one. So I've taken the selling price per unit minus 4 variable cost per unit there. I'll get what? I'll get the contribution margin per unit. This contribution margin per unit, how is that computed? I hope you can see the computation of that. This one minus the 4 what? Variable costs. Yes. So basically having that then, I can proceed and I compute now the break-even point in units. Break-even point in units. So how do I compute the break-even point in units? I'll basically apply this formula. I'll take the fixed cost, divided that with the contribution margin per unit. The contribution margin per unit. And basically that is what we have up there. So I'll take the fixed cost, this one, divided by this one there. That will give us the number of units to be produced and sold for the company to break even. And I think we can also have a value there for 2 decimal places like that. The next, I also need to compute the break-even point in shillings. The break-even point in shillings, the break-even point in what? In shillings. So to determine the break-even point in shillings, we just take whatever you have up here. That is the break-even point in units, break-even point in units. I multiply that with the selling price per unit. The selling price per what? Per unit. So I'll take whatever I have here times the selling price per unit. The selling price per unit, I have it up here, this one. So that basically gives us the break-even point in what? The break-even point in what? In revenue, or basically in shillings. So having that now, for the first year 2023, I just need to apply that formula for the next 4 years. For the next 4 years like that. Yes. So basically that is the break-even point in units, the break-even point in what? In shillings. In what? In shillings. We are done with that. So we move to the last part here. We move to the last part. Let's copy this. In case of any question, please type it in the chat box. I'll be able to see it. So here we are told using suitable graphs. Using suitable graphs, summarize, that is suitable graphs. Summarize the revenues, the profit, the break-even revenue for each of the next 5 years. So I think in this case, what you're required to do here is to come up with a dashboard. A dashboard is basically a summary of the key financial metrics and also accompanied with data visualization tools. Yes, so basically I think what we need to do here, let's have our years 2023, 2024, all the way to 2027. Yes, so I think maybe first of all, we can have a summary of the revenue. I think we can present this, all the values separately. So the revenue, will start with the revenue for 2023, which is this one. I'll basically enter and then basically apply that. All the values we have up here, all these revenues are the figures which we have down here. Yes. And I think in that case, we can first of all present this, the revenue separately in a graph. We said once you have that, we just need to highlight the entire data there like that. And then we come up here, we say insert. We come to the recommended charts here. You'll be given some recommendations here. Some recommendations like that. Maybe you can pick any of these. For example, you can pick that, but you can see there is some space which is left here. That space is because of whatever you have here. Whatever you have, this particular empty what? These empty columns here. That's why we have some space. Though no problem with that. Let me see here. So we insert. Yes, you can see that space is disappearing. You can see that space is disappearing. Yes. So basically, this is a graph which shows the projected revenue of this company for the next what? For the next 5 years. For the next what? 5 years. For the next what? 5 years. So I think we are done. See, you'll be able to do that for the other two variables, because you just need to do the same for profits. For profits, so you'll have the profit for the 5 years and also the break-even point in revenue. So you'll be in a position to do that. Mary, Sharon. Yes. Let me give that as an assignment. Let me give that as an assignment. Let me give that as an assignment. Sasa, yes. So you finish on that, and then so that we move now to the other question. So you can see this question was a simple one, a simple one, because that is a question which you could have done within very few minutes. You're done and you get all the marks. Sasa, yes, it was a simple question. So that is basically what was required there. There is now this other question which was the last sitting. Last sitting. Yes, we have it here. I hope you can see this question here. The question I'm presenting, this one is for August of 2025. If you can see the question for August 2025, please confirm. Please confirm. Can you see this question for August 2025? Or you can only see the other question which we... Okay, sawa. Can we take a short break before we come back and look on this? We take a short break of just like 5 minutes. I want us to finish on time today. I release you a little bit earlier. We take a short break, small breather or we just continue? Okay, so we take a small breather of 5 minutes, then we come back, we look on this. So small break, we come back. Yes, are you back? Can we continue? Can we proceed? Yes. So let's continue so that we finish on this question. So we are told you are the management accountant of Maras Tech Limited, a company that produces two types of product, alpha and beta. So we are told the company want to understand the cost structure, the profitability for both a product as well as the break-even point based on the following data for the month of July 2025. So we are given data about the two companies, about two products, not companies, about two products. Basically, we have two products, alpha and beta. So what we have is the selling price per unit, the variable cost per unit, the fixed costs, and the unit sold. So what are we required to do? Part A, I think we got straight to part A of our question here. Part A, basically we are required to do what? We are required to prepare the contribution margin statement and the profit, net profit for each of what? For each of the products. So we basically copy that. We paste it here on the other side. Yes, so we are required to prepare the contribution. So this is basically the contribution. This is the contribution margin statement and the profit what? And the profit statement. So remember here we have two products, unlike the other question which we had, which were preparing the profit statement basically for a number of years. So here we are preparing the profit statement for 1 year, but basically for two products. So we need to copy this, our two products, and basically we have that here. The two products, product alpha, and basically product what? Beta. Now what we are required to do here is we prepare a contribution, a contribution margin statement and the net profit statement. So basically what that means, we need to show the contribution for each of the product, and that is the total contribution and the profit. So how do we compute the contribution? Contribution is equal to the sales minus the variable costs. And then the net profit is equal to the contribution minus the fixed cost. Because I hope you can see in this question, we just have two costs. We just have two costs, the variable cost and the fixed cost. So to get the contribution for each of the product, we will take the sales minus the variable cost. And then to get the net profit, we take the contribution minus the fixed cost. So what do we start with here? We start by computing the sales. We start by computing the sales. Yes, let's have all these variables here first of all, before we proceed to do that. Maybe we need to use some of those variables down. Maybe in answering the other part of the question, we need to have these variables here. These variables here. Yes, and basically we have the other variables for the other product. Yes, so we don't have to copy for the other product. By default, Excel will be able to pick for us those values. So we need to start by computing the sales. So this paper for last sitting is basically, it was a very simple paper. It was a very good paper. You can see the kind of questions. I think we have done a number of questions, but it was a very good paper. It was a very good paper. Let's hope the paper for this time will also be as simple as this paper for last sitting. So to compute the sales, basically for each product, I will take the selling price per unit times the number of units produced and sold, these ones. As simple as that. Then I basically need to less the variable cost so that I get the contribution. I need to less the variable cost, the variable cost. So the variable cost, this one will also be straightforward. We will take the variable cost per unit, this one, times the number of units produced and sold, this one. And then I'll get what? I'll get the contribution. I'll get the contribution. The contribution. So the contribution here, this one will be equal to the sales minus the variable costs. Sales minus the variable cost, that one. And then I need to proceed and I get the net profit. To get the net profit, I'll take that contribution, I less the fixed costs. I less the fixed costs. I less the fixed what? The fixed cost. So the fixed cost is basically what we have here. So meaning that the net profit, this one will be equal to what? This one will be equal to the contribution minus the fixed costs, like that. Like that. Yes. So basically, I think I can bold this one before I apply that formula for the other product. Let me bold that one. I can also shade it. Yes. So basically, what I need to do, I apply this formula for the other product like that. For the other product like that. I think I can introduce a comma here. Okay, so I think that is it. Okay, I don't know what is happening this value for 200. Okay, let me do away this particular comma here. Same case there. Okay, so let's retype these figures manually. I don't know what is the problem with those figures. 200,000. And these other ones should be 200,000, 300,000. Yes, I think now they should be okay. Yes, so that should be okay now. That should be okay. Yes, alternatively, we can use that. Formula as is. We compute the contribution margin per unit times. Yes, but I think either of the approach should give us the correct answer. Either of the approach should give us the correct answer there. Yes, so I think basically that's what we have. Yes, so what you have computed is the contribution. You have also computed what? The net profit. So basically it was simple as that. So we move to part B. So in part B, basically what are we required to do? We are required to calculate the break-even point in units and revenue for both product. For both what? For both product. Basically here, we are not required to compute the break-even point for the company, because if we are required to compute the contribution, if we are required to compute the break-even point for this company, we need now to introduce the aspect of the wing. So, but here we are required to compute the contribution, the break-even point for each product. For each what? A product. So which basically becomes quite simple here. So that will be part B of the question. So this is the break-even point. The break-even point in units, and basically the break-even point in units and also in revenue. Yes, so how do we compute this? We just need to remember the formula. To compute the break-even point in units, we take the fixed cost divided by contribution margin. I think what is missing here is just the contribution margin. Let's just compute that one. Contribution margin per unit. Contribution margin per what? Per unit, which will be equal to the selling price per unit minus the variable cost. So for each product, so this one will be equal to the selling price, this one, minus the variable cost, this one, which is how much? Which basically will give us 400. Yes, which will give us 400 like that. And I hope these units are okay. So I think we have a problem with these particular values here. I think the person was typing them, introduced a comma, that's why you can see. They are not aligning on the left, like the other values. Because they should be aligning on the left. Okay, so I think it's okay then. So then, okay, we have now the contribution margin. So having the contribution margin, we can proceed and we compute the break-even point in units. So the break-even point in units, we just need to apply our formula here, which will be equal to the fixed cost divided by contribution margin, and which should be per unit. So this one will be equal to the fixed cost, which we have up here, divided by the contribution margin, this one, and that will give us 500 units. Then we compute the break-even point in revenue, or basically the break-even point in shillings. And you have said that this one will be equal to the fixed cost or in other terms, the break-even point in units, and then we multiply that with what? We multiply that with the selling price per unit. As simple as that. So therefore, this one will be equal to the break-even point in units, this one, times the selling price per unit, this one. Yes, so that basically give us the what? 350. Having that, then we need to apply that for the other product like that. So in that case, we have computed the break-even point in units and basically for revenue for both products, that is product alpha and the product what? Beta. Product beta. Quite simple. Quite simple. Yes. So we move to the other part here. That is basically part C of the question. Part C of the question. So what you're required to do here is to compute the margin of safety. So provided you remembered the formula here, this was a simple question here. Yes. So margin of safety in units and as a percentage. Now, how do we compute the margin of safety? Margin of safety basically is the difference between the current sales, what the company is producing and selling, and the break-even point. And the break-even what? Point. So therefore, to compute the margin of safety, we take the current sales, and actually we are taking the current sales in units because we are required to compute the margin of safety in units, the current sales in what? In units, in units, minus the break-even point in units. The break-even point in what? In units. The break-even point in units. Then to compute the margin of safety, as a percentage, margin of safety as a percentage, we do the same basically. We will take the current sales. Maybe I can just use, let's have the opening bracket here. The current sales basically in units minus the break-even point also in units. We get the difference and then we divide that with the current sales equally in units, and then by the end of the day, we multiply that with 100. We multiply that with what? With 100. That will give us a margin of safety as a percentage. So let's start by computing the margin of safety in units. So this one will be equal to the current sales. How many units is the company currently selling? So the unit being currently sold 1,500 minus the break-even point in units. Break-even point in units is this. And what does this mean? This basically means that if the current sales, if the number of units being sold, currently sold by the company reduces with 1,000, the company will obviously start making losses. That's what he means by that. So then the break-even, the margin of safety, that is, as a percentage, we will basically take this difference because this is now the difference between current sales and the break-even point in units. We divide that with the current sales, this one, which is 15, and then we multiply that with 100. We multiply that with 100. We multiply that with what? With 100. We have taken the difference between current sales in units and the break-even point, which is what we have here, and then divided that with the current sales in units, 1,500 times 100. So that will give us this one as what? As a percentage. Okay, so I think we can do this. Let's do this. Let's do away with this particular 100. And then whatever you get, we basically introduce what? Introduce a percentage here. Yes, and equally we can give our answer to the nearest whole number like that. So then we basically apply that for the other products there. For the other product. So what you have computed here is the margin of safety in units, and the margin of safety in what? Is a percentage. As what? As a percentage. Is a percentage. Yes. Quite simple. So let's move to part B. To part D. Part D, we are required to carry out sensitivity analysis. I hope you know what is sensitivity analysis. Sensitivity analysis, basically we try to change our original variables, and we see how that will impact on the profit, how will that maybe will impact on the break-even point of this product, or maybe the profit of this company. What are we told in part D? We are told to perform sensitivity analysis by calculating how a 10% variable change in all inputs, in all product data, that is, in all product data, other than the fixed costs, for both products, affect the contribution and the break-even point. So in other terms, what we're required to do here is that we vary, we change all the inputs except the fixed costs. And in that case, we are assuming all the inputs are changing, or basically we assume a 10% variable change. Variable what? Change for all inputs except the fixed what? Cost. And we see how that will affect what? How that will affect the contribution margin and the break-even point. Sasa? Yes. So let's copy this. We have it here. Yes, I think this was a very good question. A very good question here. Yes, so basically we need to have equally our products, our two products down here. Maybe we can just recopy them afresh. Yes, so we have our two products. So remember, we have now the inputs which you're using here. Basically, we have this input, 4 of them. We just copy all of them. So we need to have our inputs here. And basically, we are required to change all these inputs, except what? Except the fixed cost. And we assume that all the inputs are, or we have a 10% variable change. 10% variable change. I hope you know what is 10% variable change. In case of things like the selling price, things like the number of units to be sold, because this result to sales, these two variables we are going to assume they will increase with 10%. But for the costs, we assume or basically a 5% variable change for the costs they reduce. Sales, the selling price, units sold, a 10% variable change. Those two variables do what? Increases. Will do what? Will increase. So therefore, the selling price here for these two products will increase with 10%. So the selling price, this one will increase with 10%. We take this one and basically we increase it with 10%. To increase that with 10%, we just need to multiply that with 1 times 1. So that will come to 770. For the other product, we just apply that formula, and that one will go to 990. That is 10% variable change. Now, for the variable cost, if 10% variable change, we assume that this one reduces by 10%. Reduces by 10 what? 10%. Reduces by 10%. Now, as this, check what you are told here. You're told to assume a 10% variable change. That I think that basically what we need to 10% variable change. 10% variable change means what to the selling price? %10 variable favorable change. The selling price will reduce. Understand. But favorable. Favorable means what? Favorable. Remember the other question which we did. There was adverse. So that's why I think we are reducing the selling price. Sasa is here a 10% favorable change means that if it is sales, the sales increases. So anything which is used in the computation of sales, we are going to increase it with 10%, including the selling price per unit, including the number of units to be sold. But now for the cost, a 10% variable favorable change for cost, we assume they will reduce. Do we agree on that? Do we agree on that? Yes. Selling price automatically here will increase. Selling price will increase. The other variable we are going to increase is the number of units to be produced and sold. But for the cost, a 10% variable favorable change is a decrease as far as the cost are concerned. That's yes. I think you have agreed on that. So therefore, the variable cost, this will reduce because it's a cost. So this one will reduce by 10%. It will be 0.9 times 0.9 times what we have here, this one. So that reduces to 270. And basically, we do the same for the other product, which is beta. It reduces from 500 to 450. Now, the fixed cost, we are told that this one we assume it will not change. The fixed cost remain the same. The fixed cost remain the same. Remain the same. So the unit sold, this one, because it is used in computing the sales, a 10% favorable change, we assume that this one will also increase with 10%. This will be 1.1 times the current units produced and sold, 1,500. So that will come to 1,650. And then for the other product, it will go to 1,320. So then after changing those variables now, we are required now to see how that will affect the contribution margin and also how it will affect what? How it will affect the break-even point. So we need to compute what now here? What we need to compute is the contribution margin and not per unit. That is the total contribution margin and the break-even point. So let's compute the contribution. I'm saying this is a question which was very, very simple. Very, very simple. These are questions these were just like 23 marks. This was a very, very good question. Yes. Now, how do we compute this one? We will take the sales minus the variable cost. The sales minus the variable what? The variable cost. The variable cost. So the sales, I think we can compute this directly. So we will take this. I think we can have the opening bracket here. The sales times the selling price per unit. Not that is the selling price per unit times the number of units to be produced and sold. That will give us sales minus the variable cost. The variable cost will be equal to the variable cost per unit. Equally, I need to put that inside the bracket times the number of units to be produced and sold. This one. Yes, I've taken the sales minus the variable cost. And that basically will give us that. Then we do the same for the other product there. For the other product. So how, what is happening to the contribution here? What is happening to our contribution? I hope you can see our contribution up here. So this one was 600 for 80, but you can see now the new contribution is basically increasing. So by assuming a 10% variable change in all inputs except the fixed cost. You can see now the contribution. The new contribution is basically doing what? We have an increased contribution. Then we also need to compute the break-even point. The break-even point, and I think we can compute this one: break-even point in units, break-even point in shillings. Yes. So we start by computing the break-even point in what? In units. We just need to apply this formula. The fixed cost remain the same. This one, 200, divided by contribution margin per unit. Contribution margin per unit. This one, I'll compute that as the fixed selling price per unit minus the variable cost per unit. This one, I must put it inside the bracket like that. Yes, so that will give us what? That will give us 400 units. What about the other one? It will be 556. And because maybe these are units, so in today's class, I want us to start on this topic number 1. And the topic is nature and the classification of companies. So as far as this topic is concerned, we said that we are going to discuss a number of issues as far as the company is concerned. One, we will start by defining what is a company. Then from there, we look on basically the various characteristics or features of the company. And then from there, we look on basically the classification of companies. How do we classify companies? Because generally, we do have different types of companies. We are going to look at those different types of companies. But in this case, I want us to start by defining what is a company. And basically, this case, when we talk about a company here, this one can be defined to be an association, of persons, which is basically formed for some lawful common purpose and also registered in accordance with the Companies Act of 2015. So therefore, this is what is association of what? Of persons. Association of what? Of persons, which is basically formed for lawful common purpose, and also registered in accordance with the Companies Act of 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together and basically we start doing business together. We start doing business together. So therefore, association of persons, this basically whereby we have a number of individuals, 2 or more persons will come together. They agree to register a company in order to undertake some business, which by the end of the day is legal, or basically a business which is what? Lawful. So that is basically the definition of a company. And basically in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to carry on a business, and that business will be conducted in form of a company. So by the end of the day, we must register that company in accordance with the Companies Act of 2015. And I hope you can also be able to recall what we said in our previous class. Previously, companies were registered in accordance with the Companies Act. Companies Act Cap 486, but this particular act has been scrapped and basically replaced by the new Companies Act, that is Companies Act of 2015. You may come across some old notes which are basically talking of Companies Act Cap 486. So that act has already been repealed. Basically, it has been done away with and replaced by the new Companies Act of 2015. So today, if you to register a company, either a private company, a public company, you must register that company in accordance with the provisions of the Companies Act 2015. Now, this act here, that is the Companies Act of 2015. Companies Act of 2015 basically provides some legal framework, regarding number 1, the formation of the company, formation of the company. How should a company basically be formed? So that is clearly stipulated under the Companies Act of 2015. It also clearly stipulates issues to do with the management of the company. How should the management of the company be, or who should manage the affairs of the company, and how should those particular affairs of the company be managed? That is also something which is clearly stipulated under the Companies Act of 2015. And also we have the aspect of liquidation. So liquidation, remember yesterday I said that liquidation basically is the legal process through which the legal existence of the company is brought to an end. That is also something which is provided for under the Companies Act of 2015. How can a company be liquidated? What are the grounds for liquidating the company? And maybe the various types of the liquidation. Now, in this case, other than the Companies Act, which basically talks about the formation of the company, the management of the company, the liquidation of the company. So we also have various, or basically we have case law, or we have various case law. In this case, when we talk about case law, this in other terms we refer to it as the judicial precedent. Judicial precedent. So what do you mean by the judicial precedent? The judicial precedent, basically, these are those particular rules. Or principles, which the judges will come up with. The judges will come up with after basically deciding various cases. So mean that other than the formation of the company's management and also liquidation being governed by the provisions of the Companies Act, we also have various rules and also principles which have been formulated by the judges, also which basically provide some legal provisions regarding the formation, management, and also the liquidation of the company. Therefore, we say that in different topics, we will basically come across various rules or basically various principles which have been formulated by judges and which basically governs the aspect of forming the company, management of the company, and also the liquidation of the company. But majorly, most of the provisions regarding the formation of the company, regarding management, and also regarding the liquidation of the company, they are basically contained under the Companies Act of 2015. And therefore, most of the things we will discuss in this unit here, they are purely contained in the Companies Act of 2015. Now, in this case, we can proceed and look on what are the features or basically what are the characteristics of the company. So let's look on the features. Taking into account, we have already defined what is a company. We look on the features or basically the characteristics of a company. What are the features or basically what are the characteristics of the company? Number one, we can talk of something called the separate legal personality. The separate legal personality. Separate legal personality. So basically what this means is that once, for example, you come together and maybe you have registered a company with the registrar of companies, that company becomes a legal entity, which is separate and also distinct from its members and also its directors. So once a company has been registered here with the person called the registrar of companies, in this case, we say that there exists a kind of a shell or basically a kind of a shield which basically separates this company from its members and also its director. So what that means is that if today we have agreed to register a company, once that company has been registered with the registrar of companies, the company becomes a legal entity. That's why you see that a company is legally recognized to be having the same status just like you. So if you register a company today, that company has to pay tax to the government just like you. That company has the capacity to enter into a contract just like you. So once, or basically what that means is that once a company has been registered, once the company has been formed, a company becomes a legal entity, separate and also distinct from its members and also from its directors. So a company is not the same with sole proprietorship business, because if today you form a sole proprietorship business, that business is basically viewed to be the same with the owner. So if, for example, we come together, we form a partnership business, that partnership business is not separate from us as the partners. So that's why you see that if the partnership business is not able to pay its debt, the partners must come in and know how those particular debts will be paid. But in case of a company, if we register a company today, a company has that aspect of the separate legal personality. If the company is not able to pay its debt, those are not our debts as the members. So if the company has maybe entered into a contract, that is not our contract. If the company has some assets, are those our assets? No. So therefore, that is one of the characteristics or basically one of the features of the company. Number two, we say that the company has something called the limited liability. The limited liability. Limited liability basically means that if, for example, the company is not able to pay its debts, and then the members of the company will not be required to come in and do what? Contribute money to pay the debts of the company. So in other terms, this means that the liability of members in a company is what? Is basically limited. It's actually what? Limited. So if the company is not able to pay the debt, then the members do not have any responsibility as far as the payment of those particular debts of the company are concerned. In other terms, we can say the death of the company and not the death of who? Of the members. So the members cannot be called upon to come in, contribute money to pay what? To pay the debt of what? To pay the debt of the company. So the other feature, or basically the other characteristic of the company, is something called number 2. Also number 3. That is number 3. We have what? We have perpetual succession. Perpetual succession. Perpetual succession, or basically you can refer to this as permanent existence. Permanent existence. Permanent existence. What does this mean? Permanent existence. It basically means that once a company has been registered, a company based, or the life of the company is continuous. Because when we talk about something or continuous, this is another name for, sorry, perpetual is another name for continuous. The life of the company is continuous. The life of the company is continuous, or basically the life of the company is what? Perpetual. What this means is that if, for example, something happened to a member, or basically then a number of members, that do not in any way affect the company. That do not in any way affect what? The company. A company cannot be liquidated because maybe something has happened to a member. For example, maybe one of the members has died, or maybe one of the members has exited the company, No. So the life of the company is continuous. So once the company is formed, even if, for example, some of the members exit, some of the members are declared bankrupt, some of the members die and they leave the company, that do not in any way affect the life of what? Of the company. It's not like a sole proprietorship business, whereby if the owner dies, that can lead now to the closure of that what? Business. Equally, like what happened in case of partnership. If maybe one of the partner dies, one of the partner maybe retires, that can lead to the dissolution of a partnership. That is not the case when it comes to the company. The life of the company here we are saying is what? Is continuous. So if a member exit or something happened to the member, that do not in any way affect what? The life of what? Of the company. Number 4, we can say the company has got something called the common seal. Common seal. So when talk about the common seal, this is basically equivalent to the company seal. By saying that the company has got a company seal or a common seal, it basically means that the company has the capacity to sign its documents, to sign its what? Its document, to sign its what? Its document. So for any legal document to be deemed to be authentic, that document must be having a company seal. So therefore, a company has a common seal. The company, or that means that the company has the capacity to sign its own document. And take into account the company itself does not have, or basically the company do not have that ability to sign, to sign the document. Any document of the company, for it to be authentic, we are saying it must be having what? A common seal. A common what? A seal, or a company seal. So the other feature of basically the company number 5, we can say that the company has the contractual capacity. The company has got contractual capacity. Contractual capacity basically is the ability. This is the ability to enter into contract. The ability to enter into contract. The ability to enter into what? Into contract. The company has the capacity to enter into contract. But basically, those contracts which are entered into by the company, are they entered into by the company itself? No. So any contract which is entered into by the company is entered into by its directors. By its who? By its directors. By its directors. So the directors are the ones who enter into contract on company's behalf. But by the end of the day, those are contract of the company. They are not contract of directors, because the directors here were acting as the agent of the company. They were acting as what? As the agent of the company. They were acting as the agent of what? They were acting as the agent of the company. So number 6, we can say the company can sue or be what? Or be sued. The company can sue or be sued. It basically means that the company here can go to a court of law, take a legal action on behalf of, or basically take a legal action against a third party. And generally, the company here, or the person who will be going to a court of law to take that legal action, is basically like the management, the directors, or maybe the company's lawyer instituting a legal action on company's behalf. The company can sue in a court of law or can be sued in a court of law. So number 7, we can say here, the company has capacity to own property. Capacity to own what? To own property. The company has got the capacity to do what? To own a property. So just like a natural person, the company has the ability, has the capacity to own the property. In fact, those particular property, those particular assets which are in a company, they are not assets of the members. They are basically what? They are basically the property or asset of the company. Simply, in this case, we have said that there is that aspect of the separate legal personality. If we have come together, we have formed a company. Those assets which exist in that company, those property which exist in that company, they are not our own asset, but basically they are assets of who? Of the company. So then the other feature of the company we can say is there's something called voluntary association. Voluntary what? Association, voluntary association. So in this case, a company here, remember by definition, you have said is an association of persons. Association of persons. That association is voluntary. You can't be forced to be a member of a company. It's a voluntary. You must voluntarily accept to be what? Maybe to be a member of a company. You can't be forced. You can't be what? You can't be forced. The other feature of the company, number 9, is basically something called the transferability. Transferability of interest. Transferability of what? Of interest. When talk about the transferability of interest, it basically means that the interest in a company can be transferred. And how is your interest, or basically what is the interest in a company? Your interest in a company is basically measured in terms of the value of the shares you hold in a company. Once you are a member in a company, you have some interest, and your interest is equivalent to the shares you hold in that particular company. You can be able to transfer your interest. You can be able to transfer your shares. Though in some companies, like in private companies, private companies, the transfer of the shares is restricted. The transfer of shares is what? Is restricted. So restricted in the sense that you cannot be able to transfer your shares just to any other person. Just to any other person. You wake up today and maybe you decide that you'll sell your shares to any other person. There is some restrictions in relation to that. For example, in a private company, the requirement is that if you want to transfer or you want to sell your shares, you can only sell those shares to the existing members. You cannot sell the shares just to any other person. So the shares can only be transferred to the existing members. But basically, we are saying that there is that transferability of interest. You can be able to transfer your shares in a company. So the other feature of the company, maybe number 10, we can talk over the aspect of management. The aspect of management. So who manage the company in this case? Who manage the company? So the companies basically are managed by an organ which is known as the board of directors. These are basically a feature which applies to all companies, that companies are managed by a board of directors. By a board of what? A board of directors. By a board of what? A board of directors. This board of directors basically comprises of directors who are elected by the members to be in charge of or basically to manage the affairs of what? To manage the affairs of what? Of the company. So therefore, this basically, among others, are some of the features or basically some of the characteristics of a company. Some of the features or characteristics of what? Of the company. So basically what that means that if you go to different companies, you'll be able to see those particular features. So those features applies to various companies. So now, next, I want us to look on the classification of companies. Or basically we look on the different types of companies which we have. Classification of companies. Classification of companies. And I hope you're together up to that point. Are we together up to that point? Are we together up to that point? Are we together up to that point? Catherine, are we together? Steven, are we together up to that point? Yes. Yes, so we are together up to that particular point there. I can see someone is having a question here. Yes, so I think we're going to discuss on that case of salmon versus salmon, maybe somewhere Catherine, we're going to talk about the case of Salmon versus Salmon and the company limited. Almost at the end, there is somewhere we're going to look on the doctrine of separate legal personality in details, almost at the end of this topic. So we will discuss more on that. Okay, so classification of companies. Now here, we have various ways in terms of how companies are classified. Various ways in terms of how companies are what are classified. Various ways in terms of how companies are classified, or in other terms, we can say we have different types of companies. We have different types of companies. So number one, we have the statutory corporations, or in other terms, these are known as the parastatos. So what do you mean by the statutory corporations or parastatos? So these are those companies which are basically formed pursuant to a certain act of parliament or in accordance with a certain act of parliament for them to be able to provide some essential services to the members of the public. And these companies here, usually they are under the control of the government, or they fall under the public sector. They fall under the public what? Sector. Public sector entities are those entities which are basically established to provide essential services to the members of the public. And on the other hand, they do not operate with an objective of making what? A profit. So therefore, these are those companies which are formed in accordance with a certain act of what? Of parliament. A good example of this is 𝐎𝐻. A good example of this is 𝐎𝐻. If you do some research, you'll be able to see that 𝐎𝐻 is a statutory corporation which is formed in accordance with the Accountant Act, which is formed in accordance with the Accountant Act. Now, on the other hand, we have seen that these particular entities are basically formed to provide essential services to the members of the public, meaning that these particular entities, these companies are not formed with an objective of making profit. With an objective of making what? With an objective of making profit. And therefore, these particular entities will basically continue operating even if they are making losses. They are making losses because we are saying that their main objective is to provide some essential services to the members of the public. Now, in case they make any profit, that profit may be plowed back, may be reinvested back, or that particular profit may be paid to the government as dividend. Remember, these entities are under the control of the government. So if there's some of the parastatos basically make good profit, and basically what they do, they pay part of the profit they are making to the government as what? As dividend. So we are saying the profit they are making can be plowed back, can be reinvested back, or can actually be paid to the government in form of what? In form of dividends. So how is their capital raised? How do these parastatos raise their capital? These parastatos basically raise their capital through borrowing, and basically that borrowing is guaranteed by the treasury. So the government or the treasury is actually the guarantor. In case these parastatos are not able to repay back the amount of capital they had borrowed, who is supposed to pay that capital is automatically the government. So then from there we have the other type of company, and that is basically the registered. In other terms, you also refer to this as incorporated companies. Incorporated companies. Now, when we talk about the incorporated companies, incorporated or the registered companies, number one, these are those companies which are formed in accordance with the Companies Act of 2015. They are formed in accordance with the Companies Act of 2015, and therefore, like in a private company, the public company, and so on, they are good examples of the registered or the incorporated company. So these are those particular companies which will be formed and also registered in accordance with the Companies Act of 2015. So after these companies have been registered, after they have been registered with a person called the Registrar of Companies, they will be issued with a certificate of incorporation. They will be issued with a certificate of what? Of incorporation, in which case then these particular companies shall be regarded to be separate legal what? Separate legal entities from their members and also from their shareholders. From their what? The shareholders. And actually, these companies here, their powers and also what they do, that is something which is clearly defined under their constitutions. And basically, these two companies, they have two main types of constitution. The first constitution is known as the Memorandum of Association, and the other constitution is known as what? The Articles of what? Of Association. So in other terms, you can say that they derive their powers from these two constitutions, the Memorandum of Association and also the Articles of what? Of Association. So then from there, we can proceed and look on the other type of companies, number 3, and that is the chartered corporations. Chartered corporations. Now, chartered corporations, these are those particular companies which are basically formed upon being granted a charter, basically by the president. Usually, the companies which fall under this category are universities. Are what? Universities. Because basically what we know is that for any university to be able to offer various programs, various certificate, diploma, degree, master programs, it can only be able to do that upon being granted a charter. Upon being granted a charter by who? By the president. By the president, who is basically empowered to do that under something called the Universities Act. The Universities Act, the president is empowered to grant a charter to a university if, for example, the president will be is basically of the opinion that that particular university will basically do what? Help the country in terms of development and promotion of what? Of education. So therefore, these are those particular companies which are basically formed upon being granted a charter by the president, who we have said is empowered to do that under the Universities Act. And I've said good examples of this are what? Are the universities. Are what? The universities. Then from there, we have number 4. Number 4, we can talk of private companies. We can talk of private companies, or private company basically. Private what? A company. So private company here is actually defined under the Companies Act, because one, a private company has to be formed in accordance with the Companies Act of 2015. And the Companies Act of 2015 defines a private company as what? Or we can say a private company, this is a company which by its articles of association, which by its articles of what? Of association. So when talk about the articles of association of a company, articles of association of the company, this is actually an internal constitution of the company. An internal constitution means that this is a document which contains some rules and regulations regarding how the affairs of the company will be managed, regarding how the internal affairs of the company will be what? Will be managed. So this is defined to be a company which by its articles of association, number one, restrict the right of members to transfer shares. Restrict right of members to transfer what? To transfer shares. So if, for example, you're a member of a private company, your right to transfer shares is usually restricted. So what does that mean? It basically means that if, for example, you want to transfer, or in other terms, to sell your shares, so there is some restrictions as far as that is concerned. And I think I've given a good example that if, in case you want to sell your shares in a private company, you can only be able to sell those particular shares to the existing members. You can't sell those particular shares to just any other person. So number 2, we say is a company which by its articles of association limit the number of members to 50, limit the number of members to what? To 50. Limit the number of members to 50. The number of members in a private company cannot exceed 50. And number 3 is prohibited from inviting members of public to buy its shares, to buy, or in other terms, to subscribe its shares or debentures. So it basically means that in case a private company wants to issue shares, it can only be able to issue shares or even debentures to the existing members. It cannot be able to invite the members of the public to come and buy its shares or debentures. So therefore, this is the definition of a private company. So we have said is a company which by its articles of association, number 1, restricts the right of members to transfer shares, limits the number of members to 50, and number 3, it is prohibited from inviting the members of the public to subscribe its shares or debentures. Its shares or what? Or debentures. Now, before we proceed to look on the other company here, we can proceed and look on the other features, or maybe we proceed and look on more features, or basically the various characteristics of this company, because it is important for you to note that this is basically one of the common type of company, which is basically formed by individuals to do business. In most of the cases, if today you want to register a company as an individual, you will be registering a private company. You'll be registering a private company. This is therefore one of the common type of companies. So one of the features of this company, number 1, is that private companies have a minimum, or basically in other terms, you can say, must have a minimum of 1 member and 1 director. 1 member and 1 director. So according to the new Companies Act, or basically according to the Companies Act of 2015, so for this company to be formed private company, it requires a minimum of 1. A minimum of 1. But the repealed Companies Act, that is Companies Act Cap 486, it was requiring a private company to have a minimum of 2. A minimum of 2 members. But today, as an individual, you can register your own company as a single individual. So it requires a minimum of 1 member and 1 director. 1 member and 1 director. So that is one feature of this private company. So the other feature of the private company, we can say that this company can basically commence business upon incorporation. Incorporation is basically the process through which a company is registered with the registrar of companies. So once this company has been registered with the registrar of companies, remember you have said that the registrar of companies will issue something called the certificate of incorporation. That company can start to operate upon receiving that certificate. But we will be able to see if, for example, you are registering a public company, for that company to start operation, it's required to get another certificate still from the registrar of companies known as a trading certificate. But this company, once registered, issued the certificate of incorporation, it can be able to, or it can start, or it can commence business. So the other feature of this company, I think that is something I've mentioned here. It restricts the right to transfer shares. Right to transfer what? Right to transfer shares. So if you are a member of this company, your right to transfer shares is restricted. Now, this restriction for the transfer of shares is achieved in 2 ways. In other terms, you can say that this restriction regarding the transfer of shares is restricted in 2 ways. One is through something called director's discretion. Director's discretion. Basically, what this means is that, or basically this document here, that is the Articles of Association, which you have said is an internal constitution. We have said it basically requires that in case you want to transfer your shares, to transfer is basically to sell your shares. So in case you want to transfer your shares in a private company, you must first of all inform the directors of that company. Inform the directors that you want to sell your shares. Now, once you have informed the directors are empowered by this document, by the internal constitution, basically to do what? To decline you, or basically the directors do have that particular power not to give you a permission, or basically a consent to go ahead and basically do what? Sell your shares. They can tell you that you will not sell your shares. You will not do what? Sell their shares. In other terms, once you have informed them you want to sell your shares, they can decline to register that transfer of shares. So once they have declined to register your transfer of shares, it means that you can't be able to go ahead and you do what? You sell your shares. So that is one way through which the free transfer of shares is restricted. Number 2, It is also restricted through something called the pre-exemption clause. Pre-exemption clause. So this is still a clause which is contained in this document, Articles of Association, and which basically requires that in case you want to sell your shares in a private company, you must offer for sale those shares to the existing members. You can't offer for sale those shares to just any other person. This clause requires that you must offer for sale all the shares to who? To the or basically you must offer for sale those particular shares to the existing members of what? Of the company. This particular clause is meant to ensure that in case you are selling your shares in a private company, you are not just selling those shares to any other person, but basically you are selling those shares to who? To the existing shareholders of that company, to the existing shareholders of that wood, of that company. Yes, so those are basically two ways through which now this free transfer of shares is actually what is actually restricted. Maybe we can also say that or the other feature of this company here, number 4, we can say limit the number of members to 50. Limit number of members to what? To 50. So the number of members in this company cannot exceed what? 50. Cannot exceed what? 50. So those are basically some of the features of this private company. So then we can proceed and look on the other type of company. Remember, this was under number 4. So number 5, we have public company. Public company. What is a public company? Public company is also defined under the Companies Act. And the Companies Act defines this, or we can say that a public company, this is a company which by its articles of association, number one, do not restrict members' rights to transfer shares. Members' rights to do what? To transfer shares. So in a public company, the right of members to transfer shares is not what? Is not restricted. And number 2 here, we can say that this one is not prohibited. From inviting members of public to buy its shares. Not prohibited from inviting the members of the public to do what? To buy its shares. So this company can invite the members of the public to buy, or in other terms, to subscribe its shares or debentures. And we will be able to see that whenever a company is inviting the members of the public to buy, to subscribe its shares, that company does that by issuing something called a prospectus. By issuing a prospectus. A prospectus is any invitation by the company to the members of the public to buy or to subscribe its shares or what? Or debentures. Number 3 here, we can say its certificate of incorporation. Its certificate of incorporation clearly states that it is a public company. States that it's a public what? Company. So this is the definition of a public company under the Companies Act. Under the Companies what? Under the Companies Act. Specifically, if you go to, and this is a document, in fact, you should be able to download. If you go to any browser, you type Companies Act of 2015 PDF document, you should be able to get this act. Yes, so it's good you have this particular act, because I've said most of things we are running here, they come from this act. Specifically, for example, in this case, if you download this act and you go to section 10, of this act, this is where you get this definition. That's why you get this word definition. Yes, that's why you get that definition of a public company. Now, in this case, it is also important. There is something I've mentioned here in relation to the features of the private company here, where we have said a private company can commence business upon incorporation. Once a company is incorporated or registered with the registrar, it will be issued with a certificate of incorporation. We have said that this company can be able to commence business upon receiving that certificate. But this one, that is a public company, it can only be able to commence business after receiving another certificate called a trading certificate. Trading certificate this is not a business permit, because some students tend to confuse this with a business permit. A business permit is you get that from the county government. So, but a trading license, this is still a license which is issued by the registrar of companies. But a company is only issued with that certificate, and that only applies to public company once the company has been able to raise something called minimum subscription. Minimum subscription is basically the minimum amount of capital which is required by the company for its operation. Once this company has been registered with the registrar of companies, it is required to issue a prospectus inviting the members of the public to start buying its shares so that it can raise the necessary capital. So automatically the directors will have said that, or basically will have agreed on the minimum capital required by that company. So once that capital has been raised, the minimum capital required has been raised through the issue of shares to the members of the public. That is the only time the company can be able to start operation. And once the company raises that amount of money, it is required to notify the registrar of companies that they have been able to raise the minimum capital required. Once the registrar is notified, then the registrar will proceed and issue that company with another certificate called a trading certificate. Upon the receipt of that certificate, that is the only time a public company can be able to start operation, operation. And therefore, that capital, minimum capital required, which you're referring to as the minimum subscription, is the amount of capital required by the company to pay the preliminary expenses. Preliminary expenses are the expenses which are incurred during the formation of the company. If today you are forming a company, kuna zile expenses uta-incur. So maybe you need to pay, there is something called a stamp duty payable to the government. You also maybe the registration of the formation of the company maybe is done by your lawyer. So he will be charging with some small fee. So all those costs you incur in registering a company, refer to them as preliminary expenses. So minimum subscription must be enough to pay preliminary expenses, must be enough to pay for any asset or property acquired by by the company, must also be enough to provide the company with sufficient working capital. So working capital is basically money required for operation, but maybe buying inventory, paying the day-to-day operating expenses of the business, and so on. So therefore, once this company has been able to raise that amount of money, it is supposed to notify the registrar about the same, and basically the registrar will issue that company with a trading certificate. That is the only time this company can be able to start operating. Yes. So are we together up to that point? If you're together, want us we move to the next thing. Are we together up to that point? Catherine, Steven, Zido, are we together up to that point? Are we together up to that point? Okay, so I want us next, we look on what? We look on the features, not the features, Lana. I want us to look on the differences between these two types of companies, differences between the private and the public, private and public companies. So what are the differences? Which differences exist between these two companies? Which differences exist between these two companies? Remember, I've said these are the common types of companies which are formed by individuals to do business, either private or public companies. So which differences exist between these two companies? I think we have mentioned, we have come across some differences, like this one require a minimum of 1 member. For it to be formed, it requires a minimum of 1, whereas these require a minimum of 7 members, a minimum of 7. So this requires a minimum of 1 director, whereas this one requires a minimum of 2 directors. 2 directors. The other difference is that this company, that is private company, is not required to hold an AGM. As per the Companies Act of 2015, a private company do not have any responsibility of convening. It may hold an AGM, but it's not a requirement under the Companies Act. But this company here must convene an AGM must convene an AGM. And actually, we will discuss more on these meetings, on this meeting, AGM, in the topic of a company's meeting. We will see what is an AGM, when is AGM supposed to be held, and basically which business are transacted during such what meeting. So the other difference is that this company here, we have said, can commence business after receiving certificate of incorporation. This company, for it to commence business, we have said, other than receiving this certificate of incorporation, it must additionally receive a trading certificate. The other difference is that private company here, basically, have said restrict the right of members to transfer shares. Restrict the right to transfer what? Shares. But this one does not do what? Does not restrict. This one does not restrict the right of members to do what? To transfer shares. Does not restrict the right of members to transfer what? To transfer shares. On the other hand, this one cannot invite the members of the public. Cannot invite the members of the public to buy shares, whereas this one can do what? Can invite the members of the public to buy its shares. Can invite the members of the public to buy its what? Its shares. Can invite the members of the public to do what? To invite or basically to subscribe or to buy its what? Its shares. Maybe the other difference, we can say private company. Here, the directors are not required to obtain the qualification shares. Are not required to obtain the qualification what? Shares. So the qualification shares, generally, these are the shares which the directors of the public company are required to obtain and pay within a period of 2 months from the date they were appointed. So that applies to directors of which company? Public company. So here the directors are not required to obtain the qualification share, but here the directors are required to do what? To obtain the qualification what? The qualification shares. So those are some of the differences which exist between the private company and also the private company and the private and the public company, private and public company. So next, I think we can look on like the advantages of a private company over public company. So what are some of the advantages of a private company over public? So we have a number of advantages. One, we can say that this company here, private company, can be able to commence business upon incorporation. So once this company is registered with the Register of Companies, it can be able to commence business. It can start operating. This company is not required to obtain trading certificate. That is one of the advantages. Number two, because for this company to start operation, other than being issued with a certificate of incorporation, it must then wait and acquire the other trading certificate. Now, the other advantage of this company is that for it to be formed, it requires a minimum of one. It requires a minimum of one, meaning that to form a private company is much simpler because just one person is what is required. So the other advantage of this company, that is a private company, this company is not subjected to publicity requirement. Is not subjected to publicity requirement. What does that mean? It basically means that this company here is not required to, for example, one, publish its financial statements, make its financial statements available to the members of the public, which applies to public company. Public company must publish its financial statement, must make its financial statements available to the members of the public. Equally, in a public company, most of its documents, including MOA, AOA, and public documents, they are documents which can be accessed by any member of the public, which does not apply when it comes to what? When it comes to a private company. So the other advantage of this company is that private company is not required to hold an AGM. Is not required to hold an AGM. Remember, this is an advantage because if a company has to convene an AGM, we know that there are some costs which will be incurred, some logistical costs which will be incurred. The company must get a venue, Maybe the company will need to bring an MC. The company need to have other logistics put in place. All that means that the company will have to incur some expenses. On the other hand, if, for example, this company, the public company, fails to convene this meeting as required under the Companies Act, it can be fined. It can be required to pay a fine to the registrar because it is not complying with the requirements of the requirements of what? The requirements of the requirements of what? The requirements of the company's what? So those are basically some of the advantages of a private company. But on the other hand, we have various advantages of a public company over private. So what are some of the advantages of public company over private? One is access to capital. So if these two companies want to raise capital, the company which can be able to raise capital very fast and easily is the public company, because this company can issue shares to the members of the public, unlike private company, which is restricted from issuing its shares to the members of the public. So we can talk of easy access to capital. Number two is something called easy exit strategy. So if you have invested in a private company, it is basically easy to exit because you can just be able to sell your shares anytime and to any other person, unlike in a private company whereby your exit may be declined. Maybe you want to sell your shares, but the director tells you no, you can't sell your shares. In a public company, there is an easy exit strategy. So the other one is basically about spreading of risk. So in a public company, shares are issued to so many shareholders. So the risk has been spread to so many shareholders, unlike in a private company whereby shares are issued to maybe few individuals, to few individuals. And the other one is about the ease of selling the shares. Ease of selling the shares. If you want to sell your shares, you can be able to do that with ease. And there is no much restrictions in relation to that. In relation to that. Yes. So that basically some of the advantages of the public company over private. Now I want us to take a short break. I think we can just take a short break of 10 minutes, and then we come back. We look on the remaining types of companies, the other types of companies, and maybe we will wind up by looking on. We see whether we will be able to wind up on this. But basically, I want us first of all to take a short break. Then we come back after that short break of 10 minutes. We come back at exactly 1:18. We continue. Yes, so let's continue. I hope you're back. Yes. Are you back? Catherine, Stephen, Zido, are you back? So that we continue. Are you back? Okay, so I want us to continue with our discussion here. And I think we have just discussed on some of the advantages of a private company over public, and also the advantages of a public company over a private. So next, I want us to look on the other type of company, number 6, and that is the unlimited company. So unlimited company is what? So unlimited company basically is that particular company where the liability of members is unlimited. What does that mean? The liability of members is unlimited. It basically means that if, for example, this company that is not able to pay its debt, then what will happen is that the members of such a company will be required to come in and contribute money to pay those particular debts of the company. So meaning that this company here is just the same with a partnership, is the same with a sole proprietorship business. So the only difference is that this company one will be having perpetual succession, and also the company will be having the separate legal personality, but the liability of members is unlimited. Number 7, we have company limited by guarantee. Company limited by guarantee. And the company limited by guarantee, number 1, these are those companies which do not have share capital, share capital. Actually, this company have like 3 features. these companies, number one, do not have share capital. What does that mean? It basically means that this company do not raise capital by issuing shares. Do not raise capital by issuing shares. Simply because mostly company limited by guarantee are the not-for-profit making organizations, like the NGOs which are formed, they fall under this category here. And basically what we know is that NGOs rely on donations. They are funded by donations and also maybe maybe grants from the government. Maybe, for example, the government what? A grant. They do not have share capital. They do not raise capital by issuing shares. Number two, these particular companies here are not formed to make profit. Not formed to do what? To make profit. They are not formed to make what? A profit. And that's why I've said NGOs, they fall under this what? A category. And number three, these companies or the liability of members. The liability of members. The liability of members is limited by what? Is limited by guarantee. Is limited by what? By guarantee. So by saying that the liability of members is limited by guarantee, it basically means that when these companies are basically to be formed, each member of this company basically make a commitment that in case the company is not able to pay its debt, then they will come in and contribute a certain amount of money to help the company in terms of paying its debt. So if you are a member here, so during its formation, you must commit yourself to contribute a certain amount of money to help the company in terms of paying its what? Its debts. That's what you mean by the liability of members being limited by what? By guarantee. So these are basically the feature, the three features of these particular companies here, which are company limited by what? By guarantee. So then we can proceed and look on the other type of, or the other classification of a company. That was number 7. Number 7. So we have number 8. Number 8, and that is the company limited by shares. Company limited by shares. So when we talk about the company limited by shares, these are those particular companies where the liability of members is limited by shares. The liability of members, liability of members is limited by shares. Is limited by what? Is limited by shares. So what this means is that in case this particular company is not in a position to pay debts, then as a member of this company, you will only be required, or basically as a member of this company, the obligation which you have as far as the payment of those debts of the company is concerned is paying the amount of money which you have not paid on the shares you have been issued with. For example, you have been issued with 10,000 shares. Maybe there is some amount of money you have not paid for those shares. So what you'll be required to do in this case is you pay that amount which you have not paid on your shares to help the company to raise money to pay its debts. That's basically what you mean by your liability being limited by shares. Your obligation as far as the payment of the company's debt is concerned is limited to paying any amount of money unpaid on your shares. If your shares are fully paid, then can you be required to come in and pay any amount of money here? Automatically, no, because your shares are fully paid. So that's what you mean by company limited by what? By shares. So then from there we have a holding company, holding and a subsidiary company. Holding and subsidiary company. I think in this case, we can start by defining what is a holding company. So holding company, essentially, this is a company which has acquired the majority of the shares in another company. For example, we are told 𝐴 Limited has acquired more than 50%. That is majority of the shares in B Limited. This company here is the one which is called the holding company. The holding company. In other terms, this one is also called the parent what company, the holding or the parent company. For us now, this company here is called the subsidiary company. It's called the subsidiary what company. So, but by definition, how do we define a holding company? So a holding company, this one is defined under the Companies Act, specifically Section 3 of the Companies Act of 2015. And actually, a holding company, we say, this is a company. Basically, we have 4 definitions. Is a company is a company that number one controls the composition of the board of directors, control the composition of the board of directors of another company, controls the composition of the board of directors of another company. So a company is said to control the composition of the board of directors of another company if that company is the one which appoints majority of the directors. For example, A Limited, taking into account its whole majority of the shares in B, A Limited will be the one which appoints majority of the directors of B Limited. It therefore controls the composition of the board of directors of B Limited. Number two, we say is a company that do what? That controls more than half. Controls more than half of the voting rights of another company. Voting right of another company controls more than half of the voting rights of another company. If A Limited hold majority of the shares in B, it basically means that A controls more than half of the voting rights in B in B Limited. And number three, holds more than half of the issued of the other that is of the other company share capital. Other company share capital. So this company holds more than half of B Limited share capital. So therefore, this is the parent, whereas B is what? Is a subsidiary. And then number four here. Number four, we can say it is the holding company of a company. It is a holding company of a company that is of a company, okay, of a company which is another company holding company. So what have we said here? We have said that a holding company is a company that is a holding company of a company which is another company holding company. What does that mean? So let me illustrate that so that you understand. Assuming you have three companies, A Limited, which basically has acquired more than 50% of the shares issued by B Limited, and then this one hold more than 50% of the shares issued by who? By C. So in this case, you can see A controls B simply because this one has or basically acquires or hold more than 50% of the shares issued by B, and then B in turn controls what? Controls C. So this company controls this, and this in turn controls C. So therefore, in this case, we can see A has got some indirect interest, not indirect interest, indirect control over C. A Limited has indirect control over C. So therefore, A Limited will be a holding company as far as company C is what is concerned. So this definition number 3, definition number 4 of a holding company basically applies to this. It applies to this, where we are saying A is a holding company of company C, simply because we are saying A is a holding company of a company, is a holding company of this company, is a holding company of a company which is another's what? Holding company. So this is a holding company of this, which in turn is a holding company of another company. So therefore, A Limited is a holding company of company what? Of company C. So that is the definition of what we refer to as a holding company. So if you come across a question required to define a holding company, you need to remember those 4 definitions. Those 4 what? Definitions. Okay. So next, number 10, I want us to look on something called the foreign companies. Foreign companies, in other terms, these are known as companies incorporated outside Kenya. Incorporated outside what? Kenya. So we'll talk about the companies incorporated outside Kenya. These are those particular companies which are registered or basically incorporated in any other country other than Kenya, and this company have started operating in what? In Kenya, have started operating in Kenya. For example, a company registered in Uganda, but that company has started operating in Kenya. Now, that company, we refer to it as a foreign company. Now, the requirement of the Companies Act is that for that company to start operating in Kenya legally, it has to be registered with the Registrar of Companies as a foreign company. As a foreign company. So that company will be required to make an application with the Registrar of Companies for it to be registered in Kenya as a foreign company. Once the registrar receives that application, he will go ahead and basically register that company, provided that application for registration meets all the requirements of the Companies Act. And that company, once registered with the Registrar of Companies, it will be issued with a certificate of registration, meaning that it has been registered in Kenya or it has been registered by the Registrar of Companies as a foreign what? As a foreign company. As a foreign what? As a foreign company. As a foreign what? A company. Yes, yes. So that's basically the other type of company. And then we also have something called the corporation aggregate. I'll define this together with something called the corporation sole. So these are basically not per se types of companies, but these are types of legal entities, or legal persons. So when we talk about the corporation aggregate, this refers to those associations which comprises of two or more persons. And mostly now the private companies, that is the public companies, or those companies which comprises of two or more persons, they are good examples of corporation aggregate. Associations which are comprises of two or more persons, which have been registered and also recognized as legal entities, separate and also distinct from their members. Corporation sole, basically these are the legal offices which are actually deemed to have the same status with companies. They are those one-man offices, which are basically established by the various provisions of the law. For example, the office of the president, the office of the attorney general, the office of maybe deputy president. Those are one-man offices which are established under the various provisions of the law and actually recognized to be legal entities, which are basically separate and distinct from their members. Members. So those are basically the various types of companies, which basically you need to be aware of. I think maybe some of the questions which I've seen here, maybe like I think last week. Yes, and therefore in today's class, I want us to start on this topic number 1, and the topic is nature and the classification of companies. So as far as this topic is concerned, we said that we are going to discuss a number of issues as far as the company is concerned. 1, we will start by defining what is a company. Then from there, we look on basically the various characteristics or features of the company. And then from there, we look on basically the classification of companies. How do we classify companies? Because generally, we do have different types of companies. We are going to look at those different types of companies. But in this case, I want us to start by defining what is a company. And basically, in this case, when we talk about a company here, this one can be defined to be an association, of persons, which is basically formed for some lawful common purpose and also registered in accordance with the Companies Act of 2015. So therefore, this is what is association of what? Of persons. Association of what? Of persons, which is basically formed for lawful common purpose, and also registered in accordance with the Companies Act of 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together and basically we start doing business together. Together. So therefore, association of persons, this basically whereby we have a number of individuals, 2 or more persons will come together. They agree to register a company in order to undertake some business, which by the end of the day is legal, or basically a business which is what? Lawful. So that is basically the definition of a company. And basically, in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to carry on a business, and that business will be conducted in form of a company. So by the end of the day, we must register that company in accordance with the Companies Act of 2015. And I hope you can also be able to recall what we said in our previous class. Previously, companies were registered in accordance with the Companies Act, Companies Act, Cap 486, but this particular act has been scrapped and basically replaced by the new Companies Act, that is Companies Act of 2015. You may come across some old notes which are basically talking of Companies Act Cap 486. So that act has already been repealed. Basically, it has been done away with and replaced by the new Companies Act of 2015. So today, if you to register a company, either a private company, a public company, you must register that company in accordance with the provisions of the Companies Act 2015. Now, this act here, that is the Companies Act of 2015, Companies Act of 2015, basically provides some legal framework, regarding, number one, the formation of the company, formation of the company. How should a company basically be formed? So that is clearly stipulated under the Companies Act of 2015. It also clearly stipulates issues to do with the management of the company. How should the management of the company be, or who should manage the affairs of the company, and how should those particular affairs of the company be managed? That is also something which is clearly stipulated under the Companies Act of 2015. And also we have the aspect of liquidation. So liquidation, remember yesterday I said that liquidation basically is the legal process through which the legal existence of the company is brought to an end. That is also something which is provided for under the Companies Act of 2015. How can a company be liquidated? What are the grounds for liquidating the company? And maybe the various types of the liquidation. Now, in this case, other than the Companies Act, which basically talks about the formation of the company, the management of the company, the liquidation of the company. So we also have various, or basically we have case law, or we have various case law. In this case, when we talk about case law, this in other terms, we refer to it as the judicial precedent. So what do you mean by the judicial precedent? The judicial precedent, basically, these are those particular rules. Or principles, which the judges will come up with. After basically deciding various cases. So mean that other than the formation of the company, the company's management, and also liquidation being governed by the provisions of the Companies Act, we also have various rules and also principles which have been formulated by the judges, also which basically provide some legal provisions regarding the formation, management, and also the liquidation of the company. Therefore, we say that in different topics, we will basically come across various rules or basically various principles which have been formulated by judges and which basically governs the aspect of forming the company, management of the company, and also the liquidation of the company. But majorly, most of the provisions regarding the formation of the company, regarding management, and also regarding the liquidation of the company, they are basically contained under the Companies Act of 2015. And therefore, most of the things we will discuss in this unit here, they are purely contained in the Companies Act of 2015. Now, in this case, we can proceed and look on what are the features, or basically what are the characteristics of the company. So let's look on the features. Taking into account, we have already defined what is a company. We look on the features, or basically the characteristics of a company. What are the features, or basically what are the characteristics of the company? Number one, we can talk of something called the separate legal personality. Personality. So basically what this means is that once, for example, you come together and maybe you have registered a company with the registrar of companies, that company becomes a legal entity, which is separate and also distinct from its members and also its directors. So once a company has been registered here with the person called the registrar of companies, in this case, we say that there exists a kind of a shell, or basically a kind of a shield, which basically separates this company from its members and also its its director. So what that means is that if today we have agreed to register a company, once that company has been registered with the Register of Companies, the company becomes a legal entity. That's why you see that a company is legally recognized to be having the same status just like you. So if you register a company today, that company has to pay tax to the government just like you. That company has the capacity to enter into a contract just like you. So once, or basically what that means is that once a company has been registered, once the company has been formed, a company becomes a legal entity, separate and also distinct from its members and also from its directors. So a company is not the same with sole proprietorship business, because if today you form a sole proprietorship business, that business is basically viewed to be the same with the owner. So if, for example, we come together, we form a partnership business, that partnership business is not separate from us as the partners. So that's why you see that if the partnership business is not able to pay its debt, the partners must come in and know how those particular debts will be paid. But in case of a company, if we register a company today, a company has that aspect of the separate legal personality. If the company is not able to pay its debt, those are not our debts as the members. So if the company has maybe entered into a contract, that is not our contract. If the company has some assets, are those our assets? No. So therefore, that is one of the characteristics, or basically one of the feature of the company. Number two, we say that the company has something called the limited liability. The limited liability. Limited liability basically means that if, for example, the company is not able to pay its debts, and then the members of the company will not be required to come in and do what? Contribute money to pay the debts of the company. So in other terms, this means that the liability of members in a company is what? Is basically limited. It's actually what? Limited. So if the company is not able to pay its debt, then the members do not have any responsibility as far as the payment of those particular debts of the company are concerned. In other terms, we can say the debt of the company are not the debt of who? Of the members. So the members cannot be called upon to come in, contribute money to pay what? To pay the debt of what? To pay the debt of the company. So the other feature, or basically the other characteristic of the company, is something called number two. Also number three, that is number three, we have what? We have perpetual succession. Perpetual succession. Perpetual succession, or basically you can refer to this as permanent existence. Permanent existence. Permanent existence. What does this mean? Permanent existence. It basically means that once a company has been registered, a company or the life of the company is continuous. Because when we talk about something or continuous, this is another name for. Sorry, perpetual is another name for continuous. The life of the company is continuous. The life of the company is continuous, or basically the life of the company is what? Perpetual. What this means is that if, for example, something happened to a member, or basically then a number of members, that do not in any way affect the company. That do not in any way affect what? The company. A company cannot be liquidated because maybe something has happened to a member. For example, maybe one of the member has died, or maybe one of the member has exited the company, No. So the life of the company is continuous. So once the company is formed, even if, for example, some of the members exit, some of the members are declared bankrupt, some of the members die and they leave the company, that do not in any way affect the life of what? Of the company. It's not like a sole proprietorship business, whereby if the owner dies, that can lead now to the closure of that what? Business. Equally, like what happened in case of partnership. If maybe one of the partner dies, one of the partner maybe retires, that can lead to the dissolution of a partnership. That is not the case when it comes to the company. The life of the company here we are saying is what? Is continuous. So if a member exit or something happened to the member, that do not in any way affect what? The life of what? Of the company. Number four, we can say the company has got something called the common seal. Common seal. So when talk about the common seal, this is basically equivalent to the company seal. By saying that the company has got a company seal or a common seal, it basically means that the company has the capacity to sign its documents, to sign its what? Its document, to sign its what? Its document. So for any legal document to be deemed to be authentic, that document must be having a company seal. So therefore, a company has a common seal. The company, or that means that the company has the capacity to sign its own document. And take into account the company itself, does not have, or basically the company do not have that ability to sign, basically to sign the document. Any document of the company, for it to be authentic, we are saying it must be having what? A common seal. A common what? A seal, or a company seal. So the other feature of basically the company number 5, we can say that the company has the contractual capacity. The company has got contractual capacity. Contractual capacity basically is the ability. This is the ability to enter into contract. The ability to enter into contract. The ability to enter into what? Into contract. The company has the capacity to enter into contract. But basically, those contracts which are entered into by the company, are they entered into by the company itself? No. So any contract which is entered into by the company is entered into by its directors. By its who? By its directors. By its directors. So the directors are the ones who enter into contract on company's behalf. But by the end of the day, those are contract of the company. They are not contract of directors, because the directors here were acting as the agent of the company. They were acting as what? As the agent of the company. They were acting as the agent of what? They were acting as the agent of the company. So number six, we can say the company can sue or be what? Or be sued. The company can sue or be sued. It basically means that the company here can go to a court of law, take a legal action on behalf of, or basically take a legal.
Starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here, we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of these 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in, determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value, So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But we want to know what is the worth. What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. as an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part, at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number 1. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal. 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you're paying or receiving 400,000. That is an annuity. Or each year you're paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year 1, you'll receive 300,000. In year 2, you're getting 550 or paying or 550. Year 3, 600. Year 4, 700. Maybe let's say year 5, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year 1 and year 2, or period 1 and period 2, we have an annuity of 300,000 because they follow each other. Yeah? But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year 1 and year 3, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear, a lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what we call present value. Present value. This principal figure here is what we call present value. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of future value of a lump sum should be there. If you look at the handout, you'll see using tables to find future, but no. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annual. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. Power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20%. times this times 100,000. That is 20. That means it's more than 106,000. So 178 probably 172 800. 172 800. At least repeat your calculation. Okay, yeah, 172 800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here. Period 1, 2, and 3. Amount. Let's say 100,000. No, will that give us? No. No, that is the only way. Okay. The other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity. Future value of an annuity. Future value of an annuity, and you have seen how we get the future. I've explained what's an annuity. Future value of annuity. Future value of annuity. Now, a future value of an annuity, just like we've said, you get the annuity. It's an annuity when the amount occurs repetitively, but regularly. So future value of an annuity is computed as follows. Without wasting a lot of time, future value of annuity is equals to the annuity. You get the annuity amount times annuity amount times. So we have the future value annuity factor. The future value annuity factor, you say 1 plus r power n minus 1 over r. That's how we get the future value of an annuity. 1 plus r, and write these formulas because the way they are in the handout. Okay, they are very much simplified in the handout. Just write what I'm writing on the board. Yeah, it's there, but write. Future value of an annuity is equals to annuity times 1 plus r into brackets power n minus 1 over r. This factor here, the factor 1 plus r power n minus 1 over r is called future value interest factor of an annuity. Future value interest factor of an annuity. What have they said there? Future value interest factor of an annuity. Future value interest factor of an annuity. This one. Now, we have tables. We have tables where these factors can be read from. Like you remember what table do we have? We have math table. Do you people know what's a math table? Or maybe what we call what? Normal curve, normal distribution curve. We have tables. We have tables where you can read these factors. When we go to discounting, I'm going to share the tables so that we can see. But for future values, the tables for compounding, it's not widely used in financial management. So just get these formulas right. Yeah. So any question here? There is nothing to explain. We know R is the rate of return or the interest rate. N, it's the number of periods. So there is nothing to explain. Let's go to what? Let's have an illustration. Do we have an illustration there? From the above example, there is a statement that says no. We have an example. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest of 12%? Are you there? Have you seen that example? And finding future value of an annuity. Oh, that's due. Sorry. What is the value of 100,000 investment annually at the beginning? That's an annuity due. We are coming to that. I want us to have an illustration on the illustration on future value of an annuity. Okay, let's say from the above example, there is a part that is missing here. There is a part that is missing, but all in all, let's just write an example there. Just write something. Just write an example, an illustration. Say an investor intends to invest. An investor intends to invest shilling 60,000 at the end of each year for 4 years. An investor intends to invest shilling 60,000 at the end of each year for 4 years. At the end of each year for 4 years. Full stop and say, the investment will earn interest. The investment will earn interest at a rate of 20%. The investment will earn interest at a rate of 20%, compounded annually. The investment will earn interest at a rate of 20%, compounded annually. Compounded annually. Full stop. Determine the future value. Determine the future value of the investment. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. Determine the future value of the investment after 4 years. After 4 years. Now, future value of the investment. Now we start. This is how you should be approaching these questions. You first analyze the question. For example, here we are saying amount to invest is 60,000 at the end of each year. So annuity. We say annuity. Shillings 60,000. Annuity shillings 60,000 at the end of each year for 4 years. Period is 4 years. 4 years. Then the investment will earn interest at a rate of 20%. So 20% per annum. So we want the value of the investment after 4 years. So future value of annuity is equals to the annuity times 1 plus r power n minus 1 over r. So here you say 16,000 times 1 plus 0.2 power 4 power 4 minus 1 over 0.2. So get the value of the investment after 4 years. Then I show you another way of doing it. Get the answer, get the answer, get the answer. Three 322,080. Another person. 322,080. Another person. Alice, okay, that's fine. Now, there is another way of doing this question. So this is now, you say period 1, 2, 3, 4. Annuity or amount. Remember, this person is investing 60,000 at the end. Yeah, at the end of each period. 16. 16. 16. 16. At the end of each period, this person is investing 60. So here you say 1 plus r power n. If we want to treat each amount as a lump sum, then here we will have future value. Future value. So here we will have 1 plus r. 1 plus r. This is 0.2. 0.2. 1 plus 0.2. 1 plus 0.2. 1 plus 0.2. 0.2. 1 plus 0.2. So before that, we know we've not put n. That is what I want to illustrate here. That is what I want to illustrate here. So we are 0. We always start at 0. 0 means now 1, 2, 3, 4. We're talking about 4 years, which is 1, 2, 3, 4. So here we have at the end. We are investing at the end. So at the end of the first year, 0, 60, 60, 60, 60. I want us to put n. So this 60 that you've invested at the end of year 1, how many times will it earn interest? The 60 that you invested at the end of year 1, how many times will it have earned interest at the end of year 4? It is here. 1, 2, 3. We have invested 60 here, so it will earn a return here, a return here, and a return here. So you say power 3. That is power 3. Then the other 60 at the end of year 2 here, it will earn interest here and here. So you say power 2. The 60 that you invest at the end of year 3, it will earn interest once. So you say power 1. And the last one, the 60 that you are investing at the end of year 4, it will have earned no return. So you say power 0. So multiply and get the total. If you multiply and get the total, we should be getting the same answer as this. We should be getting the same answer as this. So the reason why I just want you to get the concept, the concept here of power what, power what, power what. So 103,680 must be the first one, 103,680. 103,680. 86,400. 72,000 and 60,000. So get the total. Get the total. $322,088. Yeah. So almost the same as what we have here, just because of rounding off, that's where there are differences. So is that okay? Let's proceed. Let's do the next one, then we go for a break. The other one is future value of an annuity due. Future value of an annuity due. Let's wrap this. Future value of an annuity due. Now, what we have talked about here, it is an annuity that occurs at the end of the period. So here we had 60. If an annuity occurs at the end of the period, like in this case, that is what we've done in part B. But now we have what we call, okay, fine, Alice, 080, okay, fine. So future value of an annuity, this is when the amount is invested or paid at the beginning of the year, at the beginning of the year. For example, if our 60 here, 0, 1, 2, 3, 4. If the investment is done at the beginning of the year, for example, here 60, 60, 60, 60, 60, we call it 1, 2, 3, 4. This is not there. We call it an annuity due. So an annuity due is an amount that is invested or paid at the beginning of the period. And this will change because now, like here we had said this is power 3 because we counted here 1, 2, and 3. But if it's an annuity due, we will now have 1, 2, 3, 4 because we are going up to the end of year 4. Because we are going up to the end of year 4. So the amount that we invested at the beginning of year 1 here will earn interest 4 times. 1, 2, 3, 4. The amount that you invested at the end of year 1 will earn interest 1, 2, 3. This will earn 1, 2, and this will earn 1. So the entire thing will change there. But now How about when we are using the formula? When we are using the formula, this is how we get the future value of an annuity due. So here we say future value of annuity due is equals to annuity times 1 plus r power n minus 1 over r. Then we add another factor here, 1 plus r. 1 plus r. 1 plus r. 1 plus r power n minus 1 over r times 1 plus r. So this is now what caters for the element of investing at the beginning of the period. So you can write that. And then we have an illustration. So back to the handout, there is an illustration. Finding value of an annuity due. We have an illustration for that. If you can check in the handout, they're saying, assuming the above example, the investment is made at the beginning of the year rather than at the end. So example, what is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years at an interest rate of 12%? So let's do that. So we're saying, what is the value of shillings 100,000? So annuity, the annuity is 100,000. What is the value of shillings 100,000 investment annually at the beginning of each of the next 5 years? The period is 5 years. Interest is 12% per annum, and it's at the beginning. So future value of annuity due is equals to the annuity. And you need to be writing these formulas every now and then. Every time you're doing a question, kindly write the formula. Even if you know the formula, just write it. So annuity times 1 plus r power n minus 1 over r times 1 plus r. So annuity is 100,000 times 1 plus 0.12 power 5 minus 1 over 0.12, then times 1 plus 0.12. So get the value. Then you are going to use this method to see. So how much are you getting? 711,518.9. 711,518.9. Now, using this method, we will have this. We will have here 0 here. 1, 2, 3, 4, 5. And remember, the reason why we are starting at 0, you must count 12. Oh, someone else is getting 424, eh? 711, 424. Okay. Another person? A third person? Okay, let's continue as we wait. So, 513, 518, around that range. Now, so I'm saying we start at 0 because we must count 518. Okay, fine. Let's go with 518. We must count 12 months before we call it a year. So we are saying we are investing 100,000 at the beginning of each year. 100,000, 100,000, 100,000, 100,000. Remember, the end of year 1 is the beginning of year 2. So this 100,000 here we are investing at the beginning of year 2, which is the end of year 1. So we are saying this first 100,000 that was invested at the beginning of year 1, how many times will it earn interest in a period of 5 years? 1, 2, 3, 4, 5. So you say power 5. The other one is power 4, power 3, power 2, and power 1. The last one that we are investing at the beginning of year 5, it will also earn interest during year 5. So at the end of year 5, it will have earned once. That is why we are saying power 1. If you do the future value here, you're supposed to get almost the same answer as what you're getting here. So just check whether you're getting the same. On 76 to 34 points. You can, okay, in this case you can round off. In this case you can round off to whole numbers. You can round off to whole numbers. In this case, there are situations whereby the decimal points will be required. So let's round off to whole numbers. The first one then should be 176 to 34, 157, 352, 157, 352, Next, 144.93. 144.93. 125 for 40. 125 for 40. And 112,000. So get the sum. $711,519. 711,519. Now the reason why we are doing these two methods, this is very short. This is like a shortcut. But we are doing this method so that you can get the concept. Because there are questions that will tell you that the amounts were invested at the beginning, the amounts were invested at the end of the period, this and this was happening. So this one is very important. Kindly get the concept. Then after the break, we will look at discounting techniques. Discounting techniques. After the break, discounting techniques. Discounting techniques. So let's have a break of like 5 minutes. And as we've said, discounting is this determination of present value from a future amount. Determination of present value from a future amount is what we call discounting. Or rather, yeah, discounting. So we start with the first one. Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is the first one. A lump sum, still the same thing as we've said. An amount that is paid or received once is what we call a lump sum. So how do we get the present value of a lump sum? Present value just say PV, present value of a lump sum is equals to future value times 1 plus R power negative N. 1 plus R power negative N. So look at this factor now. Look at this factor now. Under compounding, we were saying power N, positive N, because we were moving forward. But now, under discounting, we are saying negative, because we are moving backwards. So get the difference. Present value for lump sum is equals to future value times 1 plus R power negative N. So where this is future value, R we said is the required rate of return. N is the number of periods, as usual, number of periods. Now this factor, the factor 1 plus r power negative n, the factor 1 plus r power negative n, we call it present value interest factor. This one, we call it present value interest factor. Present value interest factor. In this one, we can read from the tables. So present value interest factor, which is indicated as this present value interest factor, R% power n. Present value interest factor, R% power n. So let me share with you the present value interest factor tables. The present value interest factor tables. Just check on your WhatsApp. Check on WhatsApp. Check in the WhatsApp group, I mean. I'm sharing the present value interest factors table, present value interest factor tables that we use for discounting. Present value interest factor tables that we use for discounting. I have shared. Once you receive it, kindly let me know. Once you receive it, kindly let me know. I want to show you how we read. Okay, but that one you're going to do in an illustration. We're going to do in an illustration. So what do you need to add here? Nothing. Nothing. So when we are using tables, we say present value of a lump sum with tables. We say present value of a lump sum is equals to future value times present value interest factor R% power n. So this factor here, this is R, this is R, this is R% power n. Present value for lump sum is equal to future value times present value interest factor R% power. Because this factor should give us same figure as we have here. So let's have an example. I want to believe we have an example there. Let's go to discounting. Skip issues to do with quarterly discounting and semi-annually discounting. Let us go to discounting techniques. Discounting techniques, and we have an example there. We have an example there. Example says, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent? So we are saying, assume you were to receive shillings 172,800 3 years from now on an investment, and the required rate of return is 20%. What amount would you receive today to be indifferent using present value? Okay, ignore that. Just ignore that. So here we have been given the future value. We've been given the future value. So here we're saying future value, it is the amount that you will receive in future. 172,800. Assume you are to receive 172,800 3 years from now, and 3 years. And the rate of interest is 20%. 20% per annum. So here we will say present value is equals to future value 1 plus r power negative n. Power negative n. So present value is equals to 172,800 times 1 plus 0.2 power negative 3 power negative 3. In short, how much are you supposed to invest today to earn to get 172,800 after 3 years at an interest rate of 20% per annum? Again, you say 100,000? 100,000, okay. 100,000. And or present value is equals to future value times present value interest factor r% power n. So this one you write 172,800 times present value interest factor 20% power 5. 20% power 5. So 172,800. So this factor now, we are going to read it from the tables. We are going to read that factor from the table that I've just shared. From the table that I've just shared, let's go there. From the table. Are you there? Kindly confirm. Confirm we're together. Oh, it's power 3, sorry. Power 3, power 3. Power 3. Thank you for your correction. I want to believe you have the table that I've shared. Now, in that table, in that paper, there are two tables. We have upper one and the lower one. And you can see some formulas written above there. So you can see the first one, they have written present value interest factor, present value of received at the end of periods, end periods. And we have the other one down there, present value of an annuity of 1 per period for n periods. So the upper table is for lump sums. The upper table is for lump sums. The lower table is for annuities. The lower table is for annuities. Now we are talking about lump sums. We are looking at the present value for lump sum. So you will go to, if you look at the upper row, in table 1, the upper row, we have percentages. The upper row, the first row, if I can say, we have percentages. And in the first column, we have periods. We have periods. So like, for example, we have periods upper. We have 1, 2, 3, 4. Then we have these percentages, 1%, 2%, 3%, all the way to 20%. We want 20%. So now, in our case, we are interested in 20% at period 3. 20% at period 3. So you go to period 3 and move up to 20%. You read the factor that is there. Just like we were doing in multiplication tables. Just like we were doing in multiplication tables, that is what you are doing. You go to the period, then go to the percentage. Or you go to the percentage, you drop up to the period that is required in the question. So read the factor that is there. At 20%, period 3. 20% at period 3, you're getting. Write the factor there, 0.5787. 5787. 0.5787. 0.5787. Then you multiply now. 0.5787 5787. So then you multiply by this factor, but not factor, but amount. How much are you getting? 99.99.36. That is just like 100,000. You can see these factors are rounded off to 4 decimal places. So, but that is what you're supposed to do. That is what we are supposed to do. Any question? Any question? Okay, fine. If no question, we proceed. Present value, no, yeah, present value of an annuity. Present value of an annuity. Present value of an annuity. We have seen what an annuity is. Present value of an annuity. Present value of an annuity. And the present value of an annuity, we say present value of annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. So have that. Present value of an annuity is equals to the annuity times 1 minus 1 plus r power negative n over r. Then we are saying this factor, the factor 1 plus 1 minus 1 minus 1 plus r power negative n over r is called present value interest factor of an annuity r% power n. Present value interest factor of an annuity r% power n. Thus present value of an annuity is equals to the annuity times present value interest factor annuity r% power n. R% power n. I can't find 0.5787. Catherine, let's go back to that table. Let's go back to that table. The upper table, 5787. We are using the upper table, Catherine. Are you there? Kindly confirm you're there, Catherine. Go to 20% under column, under row 1, the top row, go to 20%. After reaching 20%, go down. So for the annuities, this is how we, and you should be able to compute this. You should be able to use this. Remember, this formula here, this formula that you're seeing here, this one, it gives us the same figure as what we have in the tables, rounded off to 4 decimal places. You round this to 4 decimal places, you're supposed to be getting the same figure. So nothing different. So let's see an illustration. An illustration, present value of an annuity. Yeah, we have an illustration and a present value of an annuity. An illustration and a present value of an annuity. And they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. What is the maximum amount would you be willing to pay for that project if the required rate of return is 10%? So let's do that. Now, when you are ever told to determine the maximum price to pay, and I saw that kind of a question in the last sitting paper. Every time you are ever told to determine the maximum price to pay, the maximum price to pay for an asset or for anything must be equal to the present value of the expected benefits. Must be equal to the present value of the expected benefits. Maybe we can have a look at, do you have your past papers? Let's look at the past papers. Just open your past papers. I show you that question. Past papers. It must have been question 2 or 3. Open your past papers. The August 2025 paper. The August 2025 paper. August 2025 paper. Which question? Question 4A. Not sorry, not that one. Now, yeah, question 4B. Question 4B. Question 4B. If you're there, you will see that required is advise an investor interested in Mara Limited on the maximum price to pay per share. So maximum price to pay, we say maximum price to pay is equal to present value of all expected benefits or cash flows. Benefits or cash flows. So if it's a share, to get the maximum price to pay for a share, it is the present value of all expected dividends from that share. If it is an asset, like for example, a motor vehicle for commercial purposes, the maximum price that you're supposed to pay for that motor vehicle, it is the present value of all what you're expecting to earn from it. So that is what this question says. So back to the question. So what I'm trying to say is that some of these things you don't need to forget. Like I'm sure this is something that I repeated a number of times last semester. And you see it came in the exam. So maximum price to pay, kindly note, because it's a concept that will keep on applying. Back to our illustration. So they're saying, assume that a project will give you shillings 1,000 at the end of each year for 4 years. Annuity is shillings 1,000. Number of periods is 4 years. 4 years. And they're saying, what is the maximum amount would you be willing to pay for that project if the required rate of return is 10? R is 10%. Maximum price to pay, this is present value of annuity. This is the present value of our annuity. So present value of an annuity, is equals to the annuity times 1 plus R power n over r. So our annuity here is 1,000 times 1 minus 1 plus 1 minus 1 plus 0.1 power negative 4 over 0.1. So shillings. Get the figure. How much are you getting? That 169.87. That 169.87. Another person. That 169.87. Another person. That 169.87. We are waiting for another answer. Someone else kindly. Okay, let's assume that is the correct answer. Therefore, present value of annuity is equals to annuity times present value interest factor annuity r percent power n. So here 1,000 times present value interest factor annuity 10% at period 4. 10% at period 4. So 1,000 times. So now let's go back to the tables. Let's go back to the tables. So thank you, Tambua. Back to the table. We are using the lower table now. We are using the lower table now because this is an annuity. Go to 10%, drop up to period 4. Go to 10%, drop up to period 4. 10% to up to period 4, we have 3.1699. Oh no, just give me the factor. 10% at period 4 in the lower table. So I'm saying 3.1699. 3.1699. So you can see we are getting the same thing. That 169.9. That 169.9. I want to believe you've all been able to read the table. Yeah? Okay, fine. Next, we look at present value of annuity due. That is next time. We'll pick from that point next time. Number 3, present value of annuity due. Present value of annuity due. I believe we'll be able to look at all the factors, then we proceed to something else. Now, as I said, this is very important. Make sure, and that is why I don't want to rush. I do not want to rush because this concept is very important. If you get it at this point, you will have no problem going forward. You'll be very much okay. So Make sure you repeat these concepts, do the illustrations that you've done. In case of any question, you will ask. Any question for now? Any question before we close? Any comment before we close? Yes? Okay, fine. If no question, we are going to close at that point. See you on Saturday. See you on Saturday. And enjoy, or rather, have a good night. Have a good night. Check whether starter class is to ensure we are recording. So now we have missed something, but no problem. So we are saying, so maybe just a recap. So we have said time value of money. It is that the fact that over time, the value of money changes. The value of money does not remain the same. And I'm saying, assuming here, now, that is year 0 today, and we have 10 years to come. 10 years to come. So we have 1 million shillings today here. Shillings 1 million. And here we have shillings 1 million. So we're saying the value of 1 million shillings today. This, it's like, if you remember what I said, assuming someone tells you that I give you 1 million shillings today, or you wait, I give you 2 million shillings after 10 years. I either give you 1 million shillings today, or you can wait, I give you 2 million shillings after 10 years. Which one is better? And we said, holding other factors constant, because there are other factors, that can influence your decision. Maybe you are going through a difficult time and you don't care what you're going to get after 10 years, but holding other factors constant, just look at the 1 million now and the 2 million after 10 years. You said you would rather go for the 1 million, because this it may be, maybe if you determine what is the present value of 2 million shillings expected in future, because remember, this 1 million is in present value terms. This one is in present value. Present value means now. But this 2 million is in future value. This one is in future value. If an amount will be received in future, we say it is in future value form. If it's been received or paid today, we say it's in present value terms. So before you make your decision on whether to go for the 1 million or the 2 million, you're supposed to ascertain what is this 2 million in present value terms, because I'm being promised the 2 million in future value terms. But what is the present value of this 2 million in present value terms? That is, you bring it to present value terms. See, tumeanza kurecord. Oh, okay, yeah. So that was earlier. So what is this in present value terms? So when you ascertain the present value of this 2 million, that is bringing it in present value form, you may realize that it is 0.8 million. So if it is 0.8 million, you will say, I would rather go for the 1 million shillings today. Yeah, are we together? You would rather go for the 1 million shillings today, but you cannot compare 1 million and 2 million. Those two figures are not comparable, because one is in present value terms, the other one is in future value terms. You cannot compare an amount in present value terms with an amount in future value terms. If you want to have a fair comparison, or if you want to form an even ground for comparison, you must either take this 1 million to future value, or bring this 2 million to present value. And the most important thing, it is bringing, okay, either way can work. So, but you must compare the two amounts in same form, either in present value terms or in future value terms. And that is where now the concept of time value of money comes in. determining either the future value of an amount or the present value of an amount. Now, let's say something now about the time value of money. So time value of money, we've said here we have present value, and future value. So present value, we have that direction, and we have this direction. So this is to say, you can work from present value terms to future value, or you can work from future value to present value. When present value to future value, when we are doing present value to future value, we call it compounding. This one you must have done in mathematics, compounding. Compounding, it is determination of a future value from a present value. Determination of a future value from a present value. For example, in our example here, you have been given 1 million. You want to know, if I get this 1 million today, I'm going to invest. Remember, you're not just getting the 1 million and keeping it maybe under the bed. No, you'll get the 1 million and invest somewhere. If you invest, it will earn a return. So after 10 years, you will not just have 1 million, but you'll have 1 million plus a return. So we want to know this 1 million plus the return that you're going to earn, how much will it be after 10 years? That is determining the future value from a present value. And that is what we call in compounding. That is compounding. The other one, we are moving from future value to present. Like in this case, you're being given 2 million shillings after 10 years. But you want to know what is the worth? What is the worth of 2 million shillings 10 years to come? What is the present value of this amount? So you go backwards. Working from future value to present value, we call it discounting. Discounting. This is discounting. Discounting its determination of a present value from a future value. Determination of a present value from a future value. And I've said, when you are given an amount in present value terms and another amount in future value terms, and you're supposed to compare the two, you cannot compare when they are not in the same form. You're supposed either to convert them to present value or to future value and make a decision or make a conclusion. That is all about time value of money. So let's see what we have in the handout. There is a handout I've just shared. There is a handout I've just shared in the WhatsApp group. Kindly check. Kindly check. Have you seen that handout? I shared just a few minutes before the class. I want us to look at it. In case you have a question, you can ask before we proceed. In case you have a question, kindly ask. Okay, fine. Let's. I want to believe you've seen the handout. It's important to respond. Kindly respond if you've seen the handout. Okay, fine. Let's continue. Thank you, Alice and Akin, Alan as well. So up there, you can see the introduction, concepts of time value of money, introduction. A shilling today is worth more than a shilling tomorrow. All what I've explained is what you can find there. Future value techniques. Future value techniques, you can see there we have future value. That is what I've explained. An amount that will be paid or received in future, we call it a future value. Then we have present value techniques. Present value, I've said, is an amount today. As an amount today, present value. Compounding techniques, but I'm not saying you are going to make sure you go through this, the theory part. at your own free time. But this is what I've just summarized. There is no need of repeating. I just want us to walk through. Compounding techniques. Compounding techniques, we've said, okay, this is what we did in mathematics. Simple interest and compound interest. So again, that is not important, so much important. I just want us to look at the, but let's, yeah, we are under compounding techniques. Here we've talked about two concepts, the concept of compounding, the concept of discounting. So I want us to start with compounding. That is compounding techniques. That's the reason why they are saying compounding techniques. Compounding techniques. So we start with the compounding techniques, number one. Determination of a future value from a present value. Compounding techniques. Compounding techniques. Now, we start with future value of a lump sum. Okay, in here, we will not focus too much on the illustrations that we have there in the handout. I want you to make short notes. I want you to make short notes as we continue. I have some handwritten notes here that I want to share with you. So just write concepts of compounding, or compounding techniques, and we start with the first one. Future value of a lump sum. 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 Alan? Okay, I will share. But the handout is more summarized. So we start with future value of a lump sum. Now, when you talk about, the most important thing here to understand is what is a lump sum? What is a lump sum? A lump sum, this is an amount that is received or paid once. An amount that is received or paid once is what we call a lump sum. For example, let's say if you pay or receive 2 million shillings today, that is a lump sum. Or if you invest, let me show you. Let's first understand. We have two things here. We have a lump sum. We have a lump sum. And we have an annuity. And an annuity. So here, let's say we have periods. We have period 1, 2, 3, 4. So we have amounts. Let's start with lump sums. Lump sum amounts. Lump sum. Let's say in year 1, the amount is 300,000. In year 2, it's 550,000, 600,000, and 700,000. These are what we call, all these are lump sums. Okay, let's have annuities. Annuity amounts. These are like installments. They are equal 400,000, 400,000, 400,000, 400,000. So annuities, they are equal amounts received or paid regularly. Equal amounts received or paid regularly. And we say, when we say regularly, we are saying it's either monthly, weekly, semi-annually, yearly, quarterly. That means like every month you are paying or receiving 400,000. That is an annuity. Or each year you are paying or receiving 400,000. That is an annuity. Equal amounts received or paid regularly. Lump sum amounts. Lump sum amounts, you're saying this is an amount which is received or paid once. They do not repeat themselves. For example, in year one, you'll receive 300,000. In year two, you're getting 550 or receiving paying or 550. Year three, 600. Year four, 700. Maybe let's say year five, 300,000. You cannot say that since 300,000 is appearing twice, that it is an annuity. No, it is not an annuity because it has not been received regularly. You've received 300,000 after some other cash flows have been received here. Are we together? So all these are lump sums. All these are lump sums. However, if, for example, if you get 300,000 here and 300,000 here, we have two 300,000 that follow each other, this one and this one. This one will be referred to as an annuity. This is an annuity. Year one and year two, or period one and period two, we have an annuity of 300,000 because they follow each other. Yeah. But if the 300,000 occurs after, let's say, for example, here we have 700,000 and here we have 300,000. So in year one and year three, we have 300,000. These are not annuities, they are lump sums because in between them, there is a figure that is different from them. I want to believe that is very clear. That is clear. A lump sum and an annuity. This is a concept that we are going to use a lot in financial management. And that is why I want you to be able to differentiate lump sums and annuities. Again, so this was 6. Let's say this was what? This was 500. Let's say now, yeah, 300,000 there. 300, yeah, let's say 300,000 here. So in year 4 and year 5, the 300,000 becomes an annuity because they follow each other. We have two 300,000s that follow one another. So they are annuities. So I want to believe that is clear. That's okay? Okay, fine, let's proceed. So we now looking at future value of a lump sum, future value of this kind of cash flows, future value of this kind of cash flows. So when you want to determine the future value of a lump sum, future value of a lump sum, future FV, its future value of a lump sum is equals to present value, or let's say principal, what you are used to, principal times 1 plus r power n. Principal times 1 plus r power n. And this is what you call present value. Present value. This principal figure here is what we call present value. Let's see. Let's see what we have in the handout there. Check what we have there. Where are we? Where are we? Future value of a future value of a lump sum will be there. If you look at the handout, you'll see using tables to find future. No. Equation for finding future values of a single amount is derived as follows. How it is derived is not so much important to us. The most important thing is this. Yeah, this is how we get the future value of a lump sum. Future value of a lump sum is equals to principal into brackets present value times 1 plus r power n. This factor here, this factor 1 plus r power n is called what? Future value is called future value interest factor. This one is called future value interest factor. Future value interest factor. That factor is called future value interest factor. This one is very important. 1 plus r into bracket power n. So here we can say where FV is future value, R is the discounting, or not discounting rate, but rate of return. Rate of return. Rate of return. It's important for you to write this formula. Just write this, just write that. Rate of return is like the interest rate. Rate of return is like the interest rate. Yeah. Do we have an example there? So the example, yeah, there should be an example somewhere. Yeah, there is an example there. Look at that example. They're saying, assume that you've just invested Kenya shillings 100,000. The investment is expected to earn interest at a rate of 20% compounded annually. Determine the future value of the investment after 3 years. So, okay. Let's look at that. We are doing that illustration, that example. We're saying, assume that you have invested shillings 100,000. That is the present value. That is the principal. The principal amount, which is present value amount, is Kenya shillings 100,000. 100,000. Then the investment is expected to earn interest at the rate of R is 20% per annum. This per annum is very important. Okay, it is not given. They have not said per annum, but we say when you get a rate of return where the period, whether the per annum, per month, semi-annually is not stated, the standard measure is per annum. So unless it is specified like semi-annually or what, you should take it as per annum rate. So per annum is 20%, compounded annually. Determine the future value of the investment after 3 years. N, we should have said N here. N is equals to number of periods. Number of periods. Kindly have that. Number of periods. Number of periods. Make sure you write that. So here, our period is 3 years. We are investing for 3 years. So future value, we are saying, is equals to present value 1 plus R power N. So future value is equals to 100,000 times 1 plus 0.2 power 3. So get the value of the investment after 3 years. Value of the investment after 3 years is how much are you getting? There are people, no, but you must be knowing how to put this power 3 in calculators. Anyone who doesn't know, you will be assisted. Now, for example, we have two answers here. We have 172,800 and we have 106,120. Alice, I'm doubting your answer. At a rate of 20%, even in the first year, we are going to earn 20,000. Because first year one, we will say 20% times this. Times 100,000. That is 20. That means It's more than 106,000. So 178 probably 172 800. 172 800. At least repeat your calculation. Okay, yeah, 172 800. That is what you're supposed to do. Another method of getting this. Another method of getting this is or. So here you say or a very long method. You'll say period here, period 1, 2, and 3. Amount with, let's say, 100,000. No, will that give us? No. That is the only way. Okay, the other method is where we say, but this one is very long. Where you say here it's 1 plus 0.2. The figure that you'll get here, you bring it here. Then you continue. But that will not apply in this case because we are only investing 1. So you can continue. You grow by that rate. So just stick to this. Just stick to this. Any question before you continue? We want to proceed. Okay, number 2, future value of an annuity. Future value of an annuity.
Time we will do a question which is not that long. We will just do a small question. Which question do we do? We have a number of them. Yes, so let's look on the question which is here. A question. Yes, so we have a question here for December 2021. December of 2021. Which is question number 1. Question number 1. So let's go to that question here. Let's go to that question. December 2021, question 1. Yes, are you there? Are you there? Yes. So what are we told as far as that question is concerned there? So the question is, Pareto Limited is the holding company of a listed group of companies with its year ended on that year of June 2021. So we are told Pareto Limited made a number of acquisition disposals of an investment. And then you're told the following summarized draft statement of financial position relate to the group of companies for the year which ended 30th of June 2021. So we have three companies there, Pareto Limited, PABA, and 𝐻𝐿. We have the statement of financial position. We're given the non-current assets, current asset, equity, and liabilities. We have additional information number 1, all the way to note number 6. What are we then required to do as far as this question is concerned? Part A, we're required to compute the goodwill arising on acquisition of the investment in the subsidiaries. Part B, we're required to compute the gain or loss arising on the disposal of investment in the 𝐻𝐿 as reported in the individual financial statements of Pareto Limited, and number 2 in the consolidated statement of profit or loss. And part C, we are required to prepare the consolidated statement of financial position for the year which ended 30th of June 2021. So automatically, because it's a question for group account, the first thing we need to do is we come up with a group structure. We come up with a group structure. We come up with a group structure. The group structure. So where do we have information about the group structure? Automatically, in the first paragraph, we know Pareto Limited is the parent. That's basically what we know, because we are told Pareto Limited is the holding company. So Pareto Limited is the holding company. But let's go to the additional information number 1. In the additional information number 1, you're told on 1st of October 2020, Pareto Limited acquired 80% equity interest in Pamba when the retained earnings stood at 3,500 million. So in that case, we are told this company, which is called Pareto Limited, basically we are told it acquired 80% shareholding, 80% equity shareholding in the company, which is called Paba Limited. On which date? On 1st of October 2020. We are given the retained earnings of Paba on that date. So we will come back basically to that point. But can we first of all go to note number 3? Note number 3. In note number 3, we are told Pareto Limited had acquired 100% equity interest when the retained earnings of 𝐻𝐿 Limited stood at 360 million. So and then we are told the draft statement of financial position of the two companies at 31st of March 2023 are presented below. So we are given the statement of financial position of H and S. So we have the non-current asset, which comprises of PP, investment in S, and then we have the current asset comprising of inventory, receivables, cash, and cash equivalent. Then we have equity down there, which comprises of ordinary share capital, retained earnings, total equity. Then we have the non-current liabilities, which include 10% raw notes. Then we have current liabilities comprising of trade payables and trade and the current tax. Then we have additional information number 1 all the way to note number 8. So what are we required to do in our question? So Roman 1, we are required to do what? To determine the equity accounted value. Equity accounted value of the investment in S Limited on 31st of March 2019. So then we are required to calculate the goodwill arising on acquisition of the acquisition of S Limited at 1st of April 2019. And part C, we are required to prepare the consolidated statement of financial position of 𝐻 Group as at 31st of March 2023. So basically, this is a question for piecemeal acquisition as per the information which are given in paragraph 1. And therefore, the first thing we need to do here is automatically to come up with a group structure. Take into account this is a question for group account. We need to have the group structure here, the group structure. Now, if you go back to the information which we have in paragraph 1, let's go back to the information in paragraph 1. So specifically, sentence number 2. Sentence number 2, we are told, 𝐻 Limited acquired 40% equity shareholding in S Limited on 1st of April 2013 for a cash consideration of 2,500 million when the retained earnings of S stood at 360. So basically, we are told in that point that 𝐻 Limited had acquired 40% shareholding in the company which is called S Limited. On which date? On 1st of April 2013. 1st of April 2013. So, and therefore you can see that initially 𝐻 Limited was a parent and then S Limited was an associate. It was what? An associate. Then let's go to the information we have in the additional information number 1. Additional information number 1, we see what you're told. We are told 𝐻 Limited acquired a further 30% interest in S on 1st of April 2019 for a cash consideration of 2,200. That is 2,200 million. So we are told this company acquired a further 30% shareholding on which date? 1st of April 2019 for a cash consideration of 2,200 million. So basically what that means is that this company here, that is 𝐻 Limited, by the end of the day, it was able to acquire the control, because you can see that 𝐻 Limited will be having a total shareholding in S equal to what? Equal to 70%. So therefore, this is basically the date when the parent company acquired control over who? Over S Limited. And therefore, we have said when computing the goodwill, we compute the goodwill on that date. On the date the parent company acquired what? The control. So I think in our case, we already have the group structure. And I think if you go through the other information, note number 2, note number 3, 4, 5, 6, 7, and 8, you'll be able to see that this company here had not invested or did not invest in any other company. So I think having that, we can go through the additional information. We see whether there are some workings which are required. So note number 1, what are we told? Note number 1. In note number 1, you're told 𝐻 Limited acquired a further 30% interest in S Limited on 1st of April 2019 for a cash amount of 22. And then you're told at that date, the retained earnings of S amounted to 860, and the fair value of the previously held 40% interest in S Limited was 3,000 million. So in that case, you can see we are given the amount which the parent company paid in acquiring 30% shareholding, and also we are given the fair value of the original investment. The original investment is what? 40%. So that information, we are going to use it in the computation of goodwill as required in part B of that question. In computing the goodwill, we need to have the cost of additional investment, how much amount was paid in acquiring 30% shareholding, and what was the fair value of the original investment. The original investment is what? 40%. So then let's move to note number 2, and we see what you're told. And we are told at that time of achieving the controlling interest, this is the date the parent company acquired the controlling interest. We are told the fair value of its identifiable net assets approximated the carrying amount with an exception of the following items. In other terms, what you are told is that on this date, when the parent company acquired the control, when this company became a subsidiary, this company revalued assets. Revalued what? Asset. In our case, in note number 2, there are 2 assets which were revalued. In point 1, we are told an item of plant whose fair value exceeded its carrying amount by 150 million. Okay, we are told an item of plant whose fair value exceeded its carrying amount by 150 million. On 1st of April 2019, this item of plant had the remaining economic useful life of 6 years. So basically, this is what referred as the fair value adjustment. Remember, you say the fair value adjustment. This is basically the valuation of assets by who? By the subsidiary. So what we need to do, therefore, is basically to make two adjustments. So we refer to that as the fair value adjustment, the fair value adjustment, or the fair value exercise by S Limited. So in that point number 2, that is point 1 or point 2, we are told the item which was revalued is a plant. And actually, the first thing we need to do here is to determine the revaluation gain. And then from there, we compute the depreciation other charge. Sasa? Yes. So we are told that the fair value exceeded the carrying amount. The fair value was more than carrying amount with an amount of how much? With an amount of 150 million. Now, this 150 million, remember, it was not accounted for. So therefore, taking into account it was not accounted for, number 1, we will add this to the group PPE. Number 2, this one is a pre-acquisition revaluation gain, and therefore this one would be used in the computation of goodwill. When computing the goodwill arising on acquisition of this is one of the pre-acquisition reserve. Number 2, we need to compute the depreciation other charge. And basically that depreciation by S Limited. I hope you can be able to recall the formula which we use here. We take the revaluation gain, that is the formula which we use, divided by the remaining useful life of the asset times the proportion of time. The proportion of time is the time difference between the date of acquisition and the date of consolidation. In this case, when we talk about the date of acquisition, is basically the date when the parent company acquired the control. Not this date, but the date when the parent company acquired the control. Because in fact, the assets were revalued on this date, not on that date, on this date. Sasa? Yes. So therefore, the revaluation gain in our case is 150 million. We divide that with the remaining useful life, which are basically 6 years, times the proportion of time. So how many, I think in our case, we have some few months here, because we need to identify the number of months, or basically the number of years we have between these two dates. That is this date here, which we are referring to as the date of acquisition and the date of consolidation. The date of consolidation is the date we are required to prepare the group accounts. So if you go to the requirement, which is our date of consolidation in our requirement, the date of consolidation. The date of consolidation. Who can see that date? The date of consolidation. Yes, the date of consolidation is 31st of March 2019. 31st of March 2019. 31st of March 2019. 31st, oh, sorry, not 2019, sorry. Yeah. Yes, should be 2023. Sorry for that. Should be 2023. Should be 2023. Yes. Should be 2023. Yes. Let me get it clear before we move. Yes. So if we go to note number 1, our parent company acquired additional investment on that date, which is correct. And then the date we are required to prepare the group accounts is per note number as per requirement C. Yes. So should be 31st of March 2023. Yes, actually here we don't have months, but basically we have a number of years. How many years do we have here? How many years do we have here? The first year automatically added 31st of March 2020, 2020, 2021, 2022, 2023. 1, 2, 3, 4. How many years? Do we have 4 or 5 years? Fred is saying we have 5 years. Do we have 4 or 5 years between those two dates? How many years do we have? We have 4 because we have said that the first year did 2020, 2021, 2022, 2023. Yes, we have 4 years. So meaning that we are computing depreciation under charge for how many years? For 4 years. So let's work out this. Let's work out this. Let's work out this. So this one will give us 100. Now this 100, number one, this one will be deducted from the group PP. This one will be deducted from the group PP. And number two, this one will also be deducted from the retained earnings of S Limited. We also deduct that from the retained earnings of S Limited. But the key adjustment is this one, because we said in most of these questions for group account, by the end of the day, you don't have to compute the group retained earnings. And actually, this one we are going to use it in computing the group retained earnings. Let's move to point 2 of note 2. And we are told on 1st of April 2019, the same date, the directors of H Limited identified that S Limited had internally generated database of customers who had the potential of purchasing their product for identifiable period of time. So although there were no contractual or legal rights associated with the database, a professional expert estimated that a competitor of S Limited would be prepared to pay 90 million for this database. Now, even before you move to the last point, if you have a database of customers, customers and who you can be able to sell, you can be able to sell this database to the competitors. You recognize this as what? In your books of account. What is this in your books of account? This database of customers you can be able to sell to your competitors, or you can be able to use. In terms of advertising, you can be able to sell some messages to these customers, and basically they'll come and buy. They'll come and buy. Some of them, not all of them automatically. Yes. Yes, basically this one is recognized. This one is supposed to be recognized as an intangible asset. This one is supposed to be recognized as what? As an intangible asset. You recognize this as what? As an intangible asset. Sasa? Yes. So therefore, this database of customers will be recognized as a database, of which you can, what you are told in the last point, we are told that S Limited had not recognized the database as an asset in its individual financial statement. So basically, this is an intangible asset, and you can see its value was established on the date this company was acquired. So therefore, what we need to do in relation to that point, we have said that that database of customers is an intangible asset, and we are told the value for that intangible asset is how much? 90 million. So this one will be recognized within the consolidated statement of financial position as an intangible asset. And number two, because it was revalued, so then we also recognize this as a pre-acquisition revaluation gain, because you can see this is a database which existed, but its value had not been established. It was revalued. It was what? Revalued. Sasa? Yes, it was revalued. The other thing you also need to determine as far as this is concerned, in case you're told this intangible asset has a definite life, has a definite what? A definite life, you need to compute its amortization, because in such a case, if you're told it has definite life, you must be given the expected useful life. Now, there is something which you're told in that point, that this database can be able to buy from this business for an indefinite period of time. So meaning that in this case, we don't have to amortize this. We don't have to do what? To amortize this. But if you are told that These customers are likely to buy from this company for a definite period of time. Will be given the estimated life. You have to do what? You have to determine the amortization. Sasa, yes, but in this case, no amortization. We just recognize that as an asset. And number two, because it was revalued on the date of acquisition, we do what? We recognize it as a pre-acquisition revaluation gain. So someone is asking, where was 90 million? Now, basically, if you read on that point, what you're told, we are told these are database which existed in the company. And actually, on the date H Limited acquired S, that is the moment the directors of this company were able to determine the value of that database of customers. That basically what you're told. If you read that point very well, that's what you're told. That the directors of H Limited identified that S Limited had internally generated database of customers. So means that the directors of S Limited, after acquiring this, that is the moment they were able to establish there was this database, which you're saying, then it needs to be recognized as what? As an asset. Was this database acquired from another company? No, it was an internally generated. Internally generated. So if it was internally generated, it was revalued. Sasa, yes, you come up with a value for that database of customer. You have done what? You have developed. So you are not acquiring that. If it was acquired, maybe that one should be credited in the bank. Sasa, yes, but it was revalued. So that is basically the treatment for that. So then we are done with that. I hope that is clear. So let's move to point number 3. In point number 3, we are told the group policy is to measure the non-controlling interest at their proportionate share of the net asset in the subsidiary at the date of acquisition. Automatically, this point is to help you to know which method you're going to use in the computation of goodwill. Which method are we going to use here in computing the goodwill? Are we going to use the full goodwill method, or are we going to use the partial? The full goodwill method or the partial? Yes, automatically here, we do what? We use the partial. We use what? The partial goodwill method. So note number 4, we are told on 28th of March 2023, these are few days to the end of the year, H Limited sold goods worth 100 million to S Limited. So H sold goods to S Limited. And then you're told H Limited reported a gross profit margin of 20% on these goods. And then you're told S Limited had neither received nor recorded these goods in its books of account as at 31st of March 2023. Now, this is basically a consolidation, which you said is not very common, but you'll come across that consolidation adjustment in a number of questions, but not all questions. In fact, that consolidation adjustment is not common. You'll be able to see most of the questions we will do. You'll not come across that, but basically that we refer to that as the goods in transit. The goods in what? The goods in transit. GIT. The goods in transit. Now, for this particular goods in transit, basically, how many adjustments do we make in relation to this? How many adjustments do we make in relation to this? I think like 3 adjustments. 3 adjustments, which you make in relation to this. Let me briefly explain. Like in this case, we are told which company made the sales. We are told H Limited. H Limited basically sold some goods now to S Limited, but S Limited had not received nor accounted for those goods. Those goods we refer to them as goods in transit. Now, the first thing we need to do is basically to recognize those goods in the books of account of S, because they were not received nor accounted for by S. How do we recognize them in the books of this? We add them to the group inventory because they are supposed to be part of the inventory of this. And then number 2, this company will need to pay for those goods. We also add them to the group payables. We also add them to the group what? Payables. Sasa, that is first of all to recognize those goods. To recognize those what? Those goods. Number 2, because this company sold some goods to this company automatically made a profit. Now, the profit which was made by this, the full amount will not be realized. the full amount of profit will not be what? Recognized. Sorry, will not be realized. That is, will not be realized. Simply because we say that if this company sells some goods to this, the profit which is made by the selling company can only be realized if the goods are sold to third parties. So therefore, we need to compute the unrealized profit on goods in transit. So this one is computed by taking all the goods in transit times the gross profit margin. Then number 3, this company had not received and accounted for those goods. Automatically, it had not paid for them. That will also give rise to amount of intercompany debt. The amount of intercompany debt. So therefore, as far as the goods in transit is concerned, and that's why this adjustment is not that common, because you can see it requires like 3 adjustments. As far as the goods in transit are concerned, we make those 3 adjustments. Those 3 adjustments. So therefore, number 1, we have said what we need to do is to recognize the goods. To recognize goods in transit in the books of account of S. So the goods in transit, they had a value of 100 million. 100 million. 100 million. So this one, we add this to the group inventory. And then we also add this to the group payables. That is the first adjustment, to recognize the goods in the books of account of who? Of S. Sasa, number two, we need to compute the unrealized profit. Unrealized profit on the goods in what? In transit, of which this unrealized profit is always by the selling company. The selling company was was H. This one, or this is unrealized profit by H. So how do we compute this? We use that formula here. The goods in transit times the gross profit margin. So the goods in transit, 100 million. 100 million, I hope you can see that, 100 million times the gross profit margin. The gross profit margin is 20%. This will give us 20 million. This one, we less it from the group inventory. And number 2, we less it from the retained earnings of the selling company. The retained earnings of the selling company, that is who? That is the H Limited. H Limited is the selling company. H Limited is the selling company. Then the last adjustment is that these goods also give rise to something called the amount of intercompany debt. Amount of intercompany debt. But in most of the cases, you may also be told that there was another amount of intercompany debt. For example, if you go to that actually that is given in point number 5. Let's go to point number 5. In point number 5, we are told the current account between H and S did not agree due to the goods that remained in transit as per note number 4. As per 31st of March 2023, the trade receivables of H Limited included 600 million from S Limited. Now, that is all about the amount of intercompany debt. But in that case, in the first sentence, we are told the current account of H Limited and S did not agree due to the goods in transit that remained in transit as per note number 4. So, and then you are told that the trade receivables of H Limited included 600 million due from S. Due from what? Due from S. In other terms, what that means is that this company here, that is H Limited, was expecting to receive 600 million from who? From S. So we need to determine how much amount was included within the trade payables of H Limited. Not S, not H, rather S. How much amount was included in the trade payables of this? The trade payables of the subsidiary, because we are told the parent company was expecting to receive 600 million from S. How much amount was supposed to be paid by who? By by S to H. And also you must take into account what we have in note number 5. That is note number 4. Note number 4. Who can tell us how much amount was included in the payables of S? Because we are told in note number 5, the current account of H Limited and S did not agree due to the goods that remained in transit as per note number what? As per note number 4. And then you're told that as at 31st of March 2023, the trade receivables of H included 600 million due from who? Due from S. Due from S. Due from S. Now, who can tell us how much amount was included in the payables of S? How much amount was included in the payables? I'm told it's 600. But remember, we are told that the amount which should be included in the payables of these should not be the same with the amount included in the receivables of these due to what? Due to the goods in transit. Remember the goods in transit? As per note number 4, the goods in transit had a value of this one. So how much amount then was included in the books of account of this? Now, what you just need to note here, I'm told 700, I'm told 120, 600. Now, what you need to note here is that once the parent company here sells some goods to this, are we together? So once this parent company sells some goods to this, so this company accounted for that as sales. This company, that is H Limited, when it sold these particular goods of 100 million, the parent company accounted for that as receivables. So this 100 million is already included here. Is already included in the receivables of the parent. Are we together? Is already included here. And so this company debited the receivables and then credited sales. Credited sales was sales account with 100 million. But now, this company here had not received and accounted for these goods. Had not received and accounted for that good. Now, how much amount initially, before accounting for this, did the subsidiary company owe the parent? That is now the question I'm asking here. Before the subsidiary accounted for, because it had not received and accounted for this good, how much amount did it was owed by the subsidiary to the parent? Yes, that is very much correct. The amount which was included here was 500. Was what? Was 500. And that's why we have said for us to be able to make this to amount to reconcile, for us to be able to make this to amount to reconcile, that's why we have this. When we have that, yes, that's why we have this here. So because this company, once the subsidiary recognized, these 100 million will be added here. Will be what? Will be added here. So this one will be added here. By the end of the day, you'll be able to see that the amount included in the receivables of this is 600 million. The amount included in the payables of this is how much? 600 million. So by the end of the day, those current accounts will do what? Will agree. Will do what? Will agree. Sasa, yes, that's basically what was required here. So therefore, that's basically how we deal with the goods in transit. Recognize the goods, compute the amount of unrealized profit, and then determine the amount of intercompany debt. We are done with that. Let's move to the other point, which is point number 6. And you're told an impairment review carried out at the end of the year revealed that neither goodwill arising on acquisition nor the intangible assets. Remember, the intangible asset is this customer's database. This customer's database with infinite useful life had been impaired. So no impairment loss on goodwill. Number 7, you're told to ignore any deferred tax, consequences on acquisition and fair value measurement. And 8, S Limited had not issued any ordinary shares since the date of acquisition. It basically means that since this company was acquired on this date, its share capital has remained the same. The same. And I think we are done. So this question was a very simple one, provided you're able to, I think this was the only tricky note, but Once you're able to deal with that note, then the question becomes quite simple. You'll be able to see the requirements there. What we are required to compute there is something very simple. I don't know whether what is our time here? Let me see. Yes, I think I can give you a short break of just how many minutes? Yes, I think I can just give you a break of 8 minutes. We come back at 7:20. Then we finish on what is remaining. What is remaining should not take us even more than 30 minutes. Sasa? Yes. So let's take that short break. We come back at 7:20. We continue with what is remaining. Yes, so we continue, and I want us to start with the part A of the question. So if you're back, please confirm. Are you back? Grace, Daniel, are you back? Mike, Patrice, are you back? So if you're back, please confirm. I want us to start with part A. Okay, so let's start with part A. And basically what you're required to do is we determine the equity accounted value of the investment in S Limited on 31st of March 2019. In other terms, what you're required to do here in Roman 1 or in part A is we determine the investment in associate, on this date here. Remember, this company here that is S Limited, or basically the parent company acquired initially 40% of the shares in S. So S Limited was initially what? Was initially an associate. So what we are required to do is we determine the investment in associate on this date. The date the parent company acquired the control, or what was the value of the investment in associate before this company became a subsidiary. Became what? A subsidiary. So therefore, we are required to compute the investment in associate. So remember, associate is basically S Limited. On which date? On 1st of April 2019, which is the same with 31st of March 2019. Are the two dates the same? Yes. 1st of April 2019 is the same with what? 31st of March 2019. So how do we compute this one? So the same approach we use in computing the investment in what? Associate. So remember, our figures are in million of shillings. So we will start with the cost of investment. The cost of investment. How much amount was paid by the parent company in acquiring 40% shareholding. And then to this, we add the group share of the post-acquisition retained earnings. So to compute this, that is the group share of post-acquisition retained earnings. If we go back to that question, you'll be able to see we are given the retained earnings of this company between these two dates. Between those two dates. So the difference between the retained earnings between these two dates will be the post-acquisition retained earnings. And basically we get the group share of that, which will be 40%. So and then to this we said we less any impairment loss, of which there is some information which are given in note number 6, where we are told that the investment in associate had not impaired. So therefore, what is the cost of investment? When the parent company acquired 40% shareholding in S, how much amount was paid? That information, we have it within paragraph 1. Let's go back to paragraph 1 of our question. Specifically sentence 2, we are told H Limited acquired 40% ordinary shareholding in S on 1st of April 2013 for 2,500 million. So that is 2,500 million, the cost of investment. And also in the same point, we are told when the retained earnings stood at 360. So the retained earnings on this date was 360 million. And I think also we are given the retained earnings on this date. The retained earnings on the date the parent company acquired the control, and that is in note number 1. In note number 1, sentence 2, we are told at this date, that is the date when the parent company acquired the control, the retained earnings of S was 860. Was 860. So the post-acquisition retained earnings of this company here will be the difference between these two retained earnings. Because this one is pre-acquisition retained earnings, whereas this 860 is post plus pre-acquisition retained earnings. Sasa, yes, so this is comprises of both pre and post, and then the pre is how much? Is 360. So the post-acquisition will be the difference between those two retained earnings, 860 minus 360. So basically, which will give us what? Which will give us 500, and then we get the parent company share of that. The parent company share of that will be 40%. 40% of this. 40% of this, or basically 0.4. So, and that will give us what? That will give us 200, 200. Is it 200? 500 times 40%. 200, yes. So we add these two values here, and basically that will give us what? That will give us 27. So this basically what was required in Roman 1 of that question, and the marks allocated there were just 2 marks. So that and that, 2 marks. So we move to part B of the question. Part B of the question, and what are we required to do? We are required to compute the goodwill arising on acquisition of S. So the goodwill on acquisition of S, on acquisition of who? S Limited. And remember, as per the information we have in note number 3, we are computing this goodwill using the partial goodwill method. As per the information we have in note number 3, we are using the partial goodwill method. So here we need to have, let's just have 2 columns. We have 2 columns like that. 2 columns, and also our figures are in million of shillings. So how do we compute this goodwill? Remember, I've given you the format for computing the goodwill arising from piecemeal acquisition. One, we have said we compute the goodwill on this date, the date when the parent company acquired the control. How do we compute that? We start by taking the cost of additional investment. The cost of additional investment. How much amount was paid by the parent company in acquiring this 30% shareholding? This 30% shareholding. This 30% shareholding. Yes, that one should be 27 because this 500 times 40%. Yes. So the cost of additional investment, this one we have it in note 1. Note 1. This is basically where we have this. Note 1. So how much amount was paid by the parent company in acquiring additional 30% shareholding? The cost is 22. 22. And then now to this, we add the fair value of the original investment. Fair value of original investment. Original investment is that 40% shareholding, and the fair value of the original investment, still we have it in note 1, sentence 2. At this date, the retained earnings was 860, and the fair value of the previously 40% interest was 3,000. That is basically the fair value of the original what? Investment. Now, if, for example, we were using now the partial goodwill method, so here we also come and we add the NCI at fair value. NCI at fair value. We only add that here when using the full goodwill method. But in our case, we're using the partial. So this will give us 5,200. 5,200. And then now to this, we need to proceed. And basically, we do what? We less the fair value of net assets acquired. The fair value of the net assets which were acquired. Fair value of the net assets which were acquired. fair value of the net assets which were acquired automatically is something which the examiner will not give you. In most of the cases, how do we compute this one? We compute this by taking the ordinary share capital of S on this date, ordinary share capital of S plus the pre-acquisition reserves, the reserves which S Limited was having on this date, 1st April 2019, 1st April 2019, 1st April 2019, 1st April 2019. Okay. So I've said we less fair value of net assets which were acquired. And basically, I'm saying that this one would be equal to the subsidiary company ordinary share capital. So the subsidiary company ordinary share capital, this one we have it within the statement of financial position. Let's go to the statement of financial position of S, specifically at the equity. So how much is the ordinary share capital of S? Who can see that? Ordinary share capital of S. Yes, the ordinary share capital of S here is what? Is the 5,000. So then below that, we have the retained earnings. But basically that retained earnings we know is at the end of the current year. So what we are interested with is the retained earnings on this date here. 1st of April 2019, when the parent company acquired the control. And that retained earnings, we have it in note number 1. Let's go to note number 1. Note number 1, sentence 2. At that date, when the retained earnings of S amounted to 860. That is the retained earnings on 1st of April 2019, when the parent company acquired the control, 860. So in the statement of financial position at the equity, I hope you can see we don't have any other reserve. We don't have any other reserve. Maybe what else do we need to include here? We need to check whether on the date of acquisition, this company revalued assets. Did S Limited revalued asset on the date of acquisition? Yes. As per note number 1, we know that this company revalued 2 assets. It revalued plant. There was a revaluation gain of 150, and also it revalued these intangible assets. And the value for that was 90. So therefore, we have a total revaluation gain of 150 plus what? Plus 90. This one plus this one. And basically that will give us what? That will give us 240. Any other pre-acquisition reserve? We don't have any other. We don't have any other. So we get the total here. We get the total, which will be 16 and that is basically 5,000. Yes. 860 plus 240. Yes. That basically will give us 61. 61. Now, because you're using the partial goodwill method, we're interested in the net asset acquired by the parent. The net asset acquired by the parent will be 70%. 70%. But if we were using the full goodwill method, under the full goodwill method, we take 100% of this. But under the partial, we only take the net asset acquired by the parent, which will be 49 what? 70. 49.70. We less that from you're getting what? 42.70 parent. 42.70. 42.70. That is correct value. 42.70. 42 what? 70. Okay. So we less that from the amount we have here. And basically we get goodwill. We get goodwill. And the goodwill will be how much? Will be 930. 930. Also recall that goodwill is not impaired. So that basically what is required as far as that point is concerned. The marks are located there were 4 marks. What is marked in such a case? This, that, and that. So we'll see for any 4 correct item, you get 1 mark each. So you get 4 marks there. So finally, we move to part C. So what are we required to prepare? We are required to prepare the consolidated statement of profit or loss. Okay, consolidated statement of financial position as at 31st of March 2023. Now remember what we have said that in case of a piecemeal acquisition, if you are required to prepare this consolidated balance sheet, consolidated statement of financial position, what you just need to do is to establish the status of this company at the end of the year. At the end of the year, S Limited will be what? Will it be an associate? Will it be a subsidiary at the end of the year? What will be S? S Limited will be a subsidiary. Being a subsidiary, we then do a full consolidation. Full consolidation means that we combine similar items of assets and liabilities, those of S, and those of who? Those of H. So we do a full consolidation, So we just need to have a single column here. And automatically we will start with the non-current assets. So for the non-current assets, I think we have basically a number of them. We go back to the statement of financial position for individual companies. We start with the first item of non-current asset, and that is the property, plant, and equipment. So we take that of the parent, that is H, 5550, plus that of S, which is 42. And then we have some consolidation adjustment here. In relation to this revaluation of plant, we add 150 here, the revaluation gain. And then we have this depreciation other charge of how much? Of 100, which we said we less. From the PP. From the PP. Do we have any other adjustment affecting the PP? No. So I think we will come back and do the totals, but let's first of all, we have all the items here. So then below that, we have investment in S. Are we supposed to include the investment in S here? No. So instead, what we include here is the goodwill on acquisition of S. The goodwill on acquisition of S. The goodwill on acquisition of S is what you have computed there, 930. Before we proceed to record the non-current, the current asset, recall this company, that is S Limited, on the date it was acquired, there was a database of customers. And actually we said that database of customers should be recognized as what? Intangible assets. So we have intangible asset. We should take intangible asset to those of the parent, which is 0, plus this one belongs to the subsidiary, which is 90. And basically that will be 90. Remember, no amortization. Yes. I think you have already gotten the final value for this. The final value for PP. I hope you have already gotten that. How much is that? 9,800. 9,800, like that. Okay, so we move and we record the current assets. So for the current asset, we have inventory. So inventory, we record that of the parent, 27, plus that of the subsidiary. Do we have some adjustment affecting that? Yes. Number one, we have this goods in transit, which we said we need to add them to the goods to the group inventory. So we add the goods in transit. These are goods in transit. And I think we also have unreleased profit, this one, 20, which we said we less from the group inventory. We less 20, which is unreleased what? Profit. We get the final value there. That should be 45 plus 80. $45.80. Is that what you're getting? $45.80. 4580, yes. So then we have the receivables. The receivables, we have 3120 plus 2180. And then we have the amount of intercompany debt. This one, amount of intercompany debt of 600. So this one will be deducted there. So any amount of intercompany debt, remember, this one should be deducted from the receivables. I think we forgot to say that. And then this one, and basically that is the total of 600 million. This one will be deducted from the group payables. From the group what? Payables. We just start from the group receivables, this one from the group payables. Yes. So basically what do we get here? What do we get here? Should be 53 minus 600, which will give us 47. Then from there we have the cash and cash equivalents. We have 1130 plus 770. Any adjustment to this? No, because we don't have any cash in transit. This one is only adjusted with the cash in transit. And basically this will give us a total of 1819. 1900. 1900, is that what you're getting? Yes, 1900. Yes. So basically, no need of getting the total assets. We proceed and we record equity. So for equity, we take the ordinary share capital. And remember here, we said we only record the ordinary share capital of who? Of the parent company. Of the parent company only. Of the parent company only. So in case of cash in transit, and we add it. That one should be added to the cash and cash equivalents. So here we record the share capital of the parent company only. So the retained earnings, we say that moving forward is one of the items we will not be computing. Let's just ignore that one. Because we said even in an examination setup, we will not have time to compute this. No need of computing that. Moving forward, we will not be computing that. Because we said for these particular questions, you don't have to balance. You don't have to get everything correct for you to get all the marks. So then from there, we said there is also something else which should be computed and included there. The non-controlling interest, equally we can ignore that. Actually, we say these are two items I will not advise you. If you're doing this particular question in an exam, I will not advise you to compute those two items. The group retained earnings and the NCI. So we just ignore them. And then from there, we proceed. We record what? We record the liabilities. We start with the non-current liabilities. So we start with the 10% row notes. So we take that of the parent, which is basically 18, plus that of the subsidiary. Do we have any adjustment for this? No, no adjustments. No adjustments. We get the final value. And then finally, we have the current liabilities. We have the trade payables, which is basically 15 what? 1560 plus 840. Any adjustment for this? Yes. We have amount of intercompany debt. This one, 600. We rest it here. We rest that there. And basically, this one should be 2400 minus 600, which will give us what? 1800. 1800, is that what you're getting? Yes, 1800. Finally, tax. Now, there is something I think I mentioned in our previous class. Anytime you come across a question for group account, and there is a component of tax, whether it is in the income statement, whether it is in the statement of financial position, this one is always pre-marked. No single time you'll be told an item for tax is to be adjusted in any question for group account. Sasa? Yes, tax, whether it is in the income statement, because even here you may have deferred tax, always these are pre-marks. we just need to add 350 plus 200 and what? 50. And that will basically give us what? That one will give us 600. That one will give us what? 600. That one will give us 600, 600. So that question, if basically leave it at that point, even without computing those two items, you'll basically be able to get all the maths. You'll be able to get all the maths because in most of the cases, in terms of how this question will be marked, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. In most of the cases, this is how the question is marked. Any 7 at 2. You need to get 7 items correct. For every correct item, you are allocated how many marks? You are allocated 2 marks. Yes, so the whatever we should rest here from the payables should be 600. Should be 600. Sasa should be 600. 600, not 500. Because in this 500, this amount was not included. Remember this amount, which we said we are going to add to the payables? That one was not included here. That's why we added that in relation to the goods in transit. In relation to the goods in what? In transit. In relation to the goods in transit. Yes, yes. So that basically what was required as far as that question is concerned. And I've said it's not a must. You get all the maths because mostly this is how the question will be marked. Was actually marked, that is. Any 7 correct items, how many marks? Basically 2 marks for each. And you can see so many free marks here. Like what? Like maybe share capital. These are free marks. I've said any component for tax. This one is also free because no adjustment for that. No adjustment here. Yes. So yes, I think those are basically some of the free what? Free marks which you could have gotten as far as that question is what is concerned. As far as that question is what is concerned. Yes. So now, if you go through those past papers, you'll be able to see so many questions of this. So many questions on piecemeal or basically stage acquisition. What I'll do, we will only do one question because of time. But basically, once we start our revision, we will be able to do more questions on this. So I'm hoping that by 3rd of November, because I'm hoping that we should be done with this by Monday next week. Sorry, Tuesday next week, we should be done with the topic of group accounts. And then I think we will be having 2 classes remaining within that week. I think the main topic which is remaining is on reconstruction. I think reconstruction, we will do that within 2 classes. But definitely we're going to do more questions during our revision. But we will do something to do with the internal reconstruction 1 class, external reconstruction 1 class. And therefore, maybe what will be remaining are some theories and then revision. So hoping that next week we should be done. And then I'm hoping that by 3rd of November, we should embark on revision. We should embark on what? On revision, because what is important as far as these papers are concerned is that revision. That revision. So what we will be doing, for example, during our revision, we will be agreeing on the topic to revise, and then you take some time even before we meet here to revise that topic. You go through it. You go through that topic on your own. You remind yourself of whatever we discussed in class, and then once we come here, we just do some questions. Sasa, yes. So we stop at that point for today, and then what we will do once we meet, is it tomorrow? Tomorrow we move to a different concept of group account. We will be able to look on something called disposal of interest. Disposal of interest is whereby the parent company is selling some shares or maybe all the shares in a subsidiary. How do we prepare the group account? So which you'll be able to see the concept is just the same with piecemeal acquisition. And therefore, we are going to look on how we prepare the group, the group account, and equally how do we compute maybe the goodwill arising, or maybe not the goodwill, sorry, something called the gain or the loss on disposal, because the parent company is selling some shares or all the shares in what? In a subsidiary. We will be able to look on how we compute the gain or the loss on disposal. Fred is asking about the goods in transit. Goods in transit have said, Fred, there are three consolidation adjustments. Three consolidation adjustments. This is just what you need to understand. This company has not received and accounted for those goods. So we need to recognize them. We debit the inventory, we credit payables. To debit the inventory is to add. To credit the payables is to add. So we add payables, we add those goods to the inventory. You'll be able to see that what you have done here. Number two, because this company had not received an account and sold those goods, so automatically the profit which was made by the selling company, the full amount of the profit was not realized. Compute the amount of unrealized profit based on all the goods, based on the goods in transit. You less that from the group inventory. That is a key consolidation adjustment, because the other adjustment is to be deducted from the retained earnings, which you're saying no need of computing that. Number three, those goods will also give rise to something called the amount of intercompany debt. This company had not received those goods, automatically it had not paid for them. So this company is demanding 100 million from this. This one will be required to pay 100 million to this. So that gives rise to amount of intercompany. There's three consolidation and adjustment. That's that? Yes, yes. So I think let's just stop at that point for now. We stop at that point for now. We continue from there tomorrow as we move now to the different to the next concept of what? Of group account, which is basically the disposal of interest. So let's stop at that point. Have a good night. See you tomorrow.
look at some illustrations and time value of money. I want us to look at some illustrations and the time value of money, some questions. And I want you to be very keen. I want you to see that you cannot be able to do a question and the time value of money unless you've understood the concept. You will see how the questions are. You'll see how tricky the questions are, and notice that you cannot do the question and the time value of money unless you've understood that topic or you have the concept. So we will start with a question for last sitting. Last sitting we had a question on time value of money. So August 2025 paper, kindly check the August 2025 paper. August 2025 paper. There is a question on time value of money. That is what I want us to start with. So just a minute. I want to believe you are there. August 2025. Question. Question 2C. Question 2C. August 2025, question 2C. That's a question on time value of money. It's a question on time value of money. So just a minute. So now, August 2025, question 1C. Not one. Question 2C, sorry. Question 2C. The question reads, assume that you have just won a competition prize with the following options. Assume that you've just won a competition prize with the following options. Option A, lump sum payment of shillings 25.8 million in 5 years' time, with lump sum payment of shillings 25.8 million in 5 years' time. Option B, a sum of shillings 1.6 million paid as follows. Oh, that is 16 million, sorry. A sum of shillings 16 million paid as follows. We have shillings 5 million payable today. Today means now 5.5 million to be paid after 1 year, 5.5 million to be paid after 2 years. And that should add up to 16 million shillings. Option C, annual payment of shillings 1.4 million for 30 years. We are saying annual payment of shillings 1.4 million for 30 years. The first payment being made at the end of the year. And next, a perpetual payment of shillings 1.38 million. Required, assuming a required rate of return of 8%. Advice on the payment option that you would select. Assuming a required rate of return of 8%, advice on the payment option that you would select. So here now, you're supposed to understand whether you're supposed to do discounting or you're supposed to do compounding. Because here the question says, assume that you've just won a competition prize with the following options. Option 1, we're saying a lump sum payment of shillings 25.8 million in 5 years' time. That is, you'll be paid 25.8 million after 5 years. The other one, option B, they are saying a sum of shillings 16 million paid as follows. The 16 million is not being paid immediately or in lump sum, but they have broken down the 16 million into three payments. Then we have option C, annual payment. That's an annuity of 1.4 million for that years. The first payment being at the end of the year. And option D, a perpetual payment of shillings 1.38 million. So this question is testing on all the concepts that we've talked about. Present value of a lump sum, present value of an annuity, present value of an annuity in perpetuity, and all that. So that is why I'm saying, unless you've understood the concept of time value of money, discounting and compounding, you may not be in a position to answer some of these questions. And you see, that is a total of 7 marks. 7 marks, and this is how you are supposed to do that question. So we start with the option A. Oh, in short, before we start doing the question, I said you cannot compare figures which are not in the same period. You cannot compare figures which some are in period 2, others are in period 3, others after 5 years. For example, option A, we are told that the payment will occur after 5 years. Option B, we are told that the payment will occur several times, a number of payments. Option C, it is an annual payment. It is an annual payment. And option D, it is still perpetuity, an annual payment, an annuity that will be done till perpetuity. So, as I said, you cannot compare amounts which are occurring in different periods. For example, we are here today, now. Then we have 25 years to come. Then we have perpetuity. Then we have some other periods here. We have 5 years. You cannot compare amounts which are being paid or received in different periods. What you're supposed to do, it is to bring them to present value. Bring all these figures to present value. Bring them, all of them, to present value so that you can compare the figures at present value, in present value terms, and advise the investor accordingly. So the first thing, it is to bring the figures to present value and choose an option that provides us or gives us the highest amount in present value terms. You choose an option that gives us the highest amount in present value terms. That is what you're supposed to do in that question. So let's start with option A. Let's start with option A. Option A, a lump sum payment of shillings, lump sum. A lump sum payment of shillings 25.8 million, which will be paid after 5 years. N is equals to 5 years. Remember what we said? Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is equals to the lump sum. Present value of a lump sum is equals to the future value times, let us use the tables. Let's use the tables. Times, but we said 1 plus r power negative n, which can also be written as future value is equals to present value interest factor r% power n. So in this case, we will have our 25 million times present value interest factor. Our R is 8%. Our R is 8%. So you say 8% power 5. 8% power 5. So this will be 25.8 million. Then you read this factor from the tables. Read 8% at period 5 from the tables. And you save time. You save time. I'm waiting for 8% at period 5. Yes. You do not have the tables? May have the tables, but I want you to read. I want you to give me the factor. Like now what Alan has done, Alan, that is wrong. Alice, that is wrong. That is what I wanted. That is actually what I wanted, because this is a lump sum. This is a lump sum. So we are using the upper table, present value interest factor tables. This is a lump sum. What you're giving me is for an annuity. Yeah. So Edith, yours is 0.6806. Let me check. Yeah, that is right. 0.6806. We said a lump sum is that a payment. It's a payment or a receipt which occurs once. Like in this case, this person will be paid 25.8 million once after 5 years. After 5 years. That's why we are using this factor, because it is a lump sum. So multiply, get the answer. Multiply. You're taking too long. 17.55. 17.55. 948 million. That is option A. Option B. Option B says what? Option B says a sum of shilling 16 million paid as follows. A sum of shilling 16 million paid as follows. So here, option B. We'll have year, amount, discount factor, you're using 8%, present value. So the first one, we are saying a sum of shilling 16 million paid as follows. 5 million payable today. Today is year 0. 5 million. 5 million shillings. Then 5.5 million paid to be paid after 1 year. After 1 year, they will receive 5.5 million. Next, 5.5 million to be paid after 2 years. So after 2 years, 5.5 million. This is what you are saying, if we can illustrate here. This is year 0, or not, this is now. This is in present value terms, today, present. Then we have year 1, and we have year 2. 5 million will be paid here, 5.5 million here, and 5.5 million here. That's why we're saying after 1 year. After 1 year, 5.5 million. After 2 years, this one and this one, 5.5 million. So here, the discount factor at present, at year 0, the present value interest factor is 1. Or rather, yeah, the factor here is 1. It is in present value terms. And that is what we are looking for. So here we will have 5 million. How about 8% at period 1, 8% at period 2? Note, just a minute. This is an annuity. This is an annuity. I will show you 2 ways of doing this. I will show you 2 ways of doing this. So but let's start with this. Use the upper table to get these figures here. Use the upper table to get this. Don't take too long to read these factors from the tables. And I want you to read for yourselves so that you can make mistakes and we correct those mistakes. So what is 8% at period 1? 8% at period 1. $0.9259, 0.9259. Year 2, 0.85, 8573. So we multiply now. We multiply. So this is 5.09245. The other one is 8573. That is 4.715. 4.71515. So then the amount here, the total amount here should be, so plus 5.09245 plus 5, 14.8076. 14.8076. That is the first way of doing that question. Or remember, this and these are annuities. The 5.5 million is an annuity because they are following each other. So here you can say this, or amount is the 5 million times 1, because that is in present value terms, plus 5.5 million times present value interest factor annuity, 8% at period 2. 8% at period 2. So that will be, this is 5 million plus 5.5 times, we read 8%. So give me this factor. Give me this factor. 8% present value interest factor annuity, present value interest factor annuity, 8% at period 2. There are two ways. I'm showing two ways, Akinyi. I'm going to explain this. So like now, Edith, you've got it wrong. It's 1.78, 8% at period 2, 1.7833. So multiply, see whether you're going to get the same answer as what we have above there. So this will be 5 times 5.5 times 1.7833. How much are you getting? Yeah, 14 points. Almost the same, 14 points. 14 points. 80815 million. So which is almost the same. So please note, when you're given cash flows like these ones, year 1, 2, 3, and 4, cash flows or amounts, you're told 100, 10,000. Let's go with 10,000. 10,000, 10,000, 10,000, 10,000. This is an annuity, but you can still use the upper table. You can still treat them as lump sums. Shadrach, yours is 14, or you're dealing with what? Millions. So I'm saying, and this is, I'm answering Akinyi. We're saying these are annuities, but you can still use the upper table to get the present value of this by having the factor at period 1, the factor at period 2, at period 3, and at period 4. However, there is a shortcut. There is a shortcut whereby you will say 10,000 times present value interest factor annuity R% power 4, this 4. That is a shortcut. But you can still treat them as lump sums and get the present value of each, like what we've done here. Is that clear? So annuity starts at year 0. Alan, what are you saying? Alan, annuity starts at year 0. Yeah, and ends at when? But we are told the amount is being paid at the end of year 1. Yeah, Alan, I'm saying it starts at it's being paid at the end of year 1. Here, remember, we talked about annuities that are paid at the beginning of the period and annuities that are paid at the end of the period. If we were told that the amount will be paid at the beginning of each period, it would have been an annuity due. It would have been an annuity due. But in this case, we've been told, let's go back to the question. It's also important to recheck. They are saying, a sum of shilling 16 million paid as follows. Shillings 5 million payable today, and today we have said this is year 0. Then 5.5 million to be paid after 1 year. So if you from today, you're being paid after 1 year. That means it is at the end of year 1. And the other one, 5.5 million to be paid after 2 years. So Alan, I believe that's okay. Okay, let's continue. So now you've seen the two ways of doing that question. Make sure and that is why I'm saying you have to understand. You need to understand. You don't need to just cram. No, you need to understand why this method is the same as this. If you had this and this plus this, it will give you this. Can you try this? 0.925 plus 0.8573 must be almost the same as this factor, because the annuities, we get annuities from the present value interest factor table. These things are related. They are related. I don't know. Let me check. Are you adding 0.9259 plus 0.8573? Yeah, almost the same. So that's why, because if this plus this is equals to this, then that's why we are picking just this and multiplying with this. So let's continue. Kindly, if you have a question, just ask. I want you to understand. Option C, annual payment of 1.4 for 30 years. For 30 years. Option C, this is annuity. That's an annual payment is an annuity. Of shillings 30 million? No. Of 1.4 million? Of shillings 30 million? No. Of 1.4 million? 1.4 million. The period is 30 years. The period is 30 years. Our R is 8%. Then the first payment being made at the end of the year. The first payment being made at the end of the year. Now, look at this. This is a very good example, actually. Now, we've said here that we have 1, 2, 3. Like in this case now, we're saying 1, 2, 3, 4, 5 for 30 years. They are paying 1.4 million. So what are they saying? 1.4 million each. 1.4, 1.4, 1.4, 1.4, 1.4, 1.4, 1.4 up to. You can still treat this as lump sums and use the upper table to get the present value of this. But do you think that will consume a lot of your time? 30 times, 30 years, from 1 to 30. Then you multiply by each factor. Like in this case, you multiply, then you get the summation. That is a lot of work. That is tedious. That's why we're saying when it is an annuity, you do not need to use the upper table. You just get that figure, that annuity figure times the present value annuity factor. So here you'll say present value of annuity is equals to the annuity times present value interest factor, annuity, R% power N. Another important factor, another important thing in this question is we are option C, that is. In option C, we are being told that the payment will occur at the end of the period. The first payment being made at the end of the year. So this is an annuity that occurs at the end of the period, not at the beginning. So here you'll say 1.4 times present value interest factor annuity, 8% power 30, because our N is 30. So read 8% at 30 years. Annuity. And kindly, if you're having a challenge, make sure you revisit these things or you ask. I want someone to read 8% at period 30, 11.2578. So the total amount multiplied by 1.4. At least multiply by 1.4. $15.76 092 millions And if you have a question, feel free to ask. Feel free to ask. Option D. Option D. Option D says a perpetual payment of shillings 1.38 million. A perpetual payment, that's an annuity first. That's an annuity of shillings 1.38 million. Period N is perpetuity. Remember how we get the present value of an annuity in perpetuity. Present value of annuity in perpetuity is equals to the annuity. You divide by what? R. So our R is 8, bado. R is 8%. So 1.38 you divide by 0.08. You divide by 0.08. So how much are you getting? $17.25 million. 17.25 million. Any question? Any question? Before we proceed? I want people to ask questions. Yeah, the table is always provided. The table is always provided. Both the present value interest factor table and the annuity factor tables. I don't know whether you can see here. This is an exam paper. You can see here, these are the tables. They are always provided. But you also need to be able to compute using your calculators. You should also be able to do using your calculators, because you can be given a factor, a percentage, a rate that is not in the table. For example, if you look at the table, there is no 17%. So if someone wants to bother you, they'll say 17%, and maybe it's not in the tables. Or 11, is 11 there? 11 is not there. So you should be able to compute using your calculators. For the annuity factor table, or rather, for annuities, we say it is 1 plus R power negative N over R. That is for annuities. For interest factors, like in this case, which one? This one. Here we said it's 1 plus R power N. We get the same factor as when we are using the tables. It is always important to use the table, Alan, to minimize chances of making mistakes. To minimize chances of making mistakes, you'd rather go for the table rather than using the calculator, because you see, if you mess with your calculator, you are done. So it's always important to use, I recommend the tables when the rate is there. So I want us, or we want to advise. No, you have to say something. You have to say something. We said we go for the option that provides the highest amount. Option A, it's 17.5 million. Option B, it's 14 million. 14.8 million. Option C is 15.76 million. And option D is 17.25 million. So we go with option A. So we go with option A. The question was, assuming a required rate of return of 8%, advise on the payment option that you would select. So just say, I would select option A. I would select option A. I would select option A because it provides the highest amount. Because it provides the highest amount, in present value terms because it provides the highest amount in present value terms. In present value terms. Is that okay? Okay, fine. Another question. Another question. So how was this question? Was it challenging or it was a straightforward question? The way you can see it. Yes? Okay, let's look at December 2023, question C and D. December 2023. December 2023. Question 3, C and D. Question 3, C and D. So December 2023. We start with question. No, we will not do C first. There is a bit that you're supposed to look at. That should be our next thing, the loan amortization. Let's look at question 3D. 3D. So that's December 2023. Question 3C is what we will do next. Are you there? The question reads, 𝐎𝐿𝐄𝐄 has the following investment options to choose from. So this person has the following investment options to choose from. Post office MIS scheme, monthly interest 8% per annum. Monthly interest 8% per annum. Next, ICD bank deposits, quarterly interest 8.25% per annum. HDFC Limited, half yearly interest 8.5% per annum. Required using effective interest rate method. Advise 𝐎𝐿𝐄𝐄 on the preferred investment option. On the preferred investment option. So this is multi-period compounding and discounting. So you remember we talked about the effective interest rates, yeah? So effective interest rates. This is December 2023. Question 3C. Effective interest rate, we said is equals to 1 plus R over M power M minus 1. Power M minus 1. Whereby we said power M is the number of times compounding occurs in a year. The number of times compounding occurs in a year is what we call in M. So now here, we start with the first one, post office MIS scheme. post office MIS scheme. The interest rate here is 8% per annum. The payments here, it's monthly interest. So our M is 12. So effective interest rate is equals to 1 plus 0.08 over 12 power 12 minus 1. So how much are you getting? The effective interest rate for post office Someone give me the answer, kindly. Save time, save time. You have a number of things to do. So 0.08299, call it 0.083. So this is 8.3%. 8.3%. That is for the post office MIS scheme. Next, ICD bank deposit. The rate is R is 8.25% per annum. This is quarterly. Our M is 4. So effective interest rate is 1 plus 0.0825 over 2 not 4 over 4 power 4 minus 1. Whatever answer you get, multiply by 100. %8.51%. So we are multiplying by 100%, whatever answer we are getting. And next, thank you for your answers, Alan and Stephen. HDFC Limited. Here, interest is half yearly, but 8.5% per annum. 2, and then effective interest rate, which is 1 plus 0.085 over 2 power 2 minus 1. %8.68%. %8.68%. Any question? Okay, now before any question, advise 𝐎𝐍𝐿 on the preferred investment option. Advise this person on the preferred investment option. Remember, the question says, 𝐎𝐍𝐿 has the following investment options to choose from. This is someone who wants to invest. This is someone who wants to invest. So which investment option is better? The one that provides the highest rate is what we are supposed to adopt. That is option C.